Hello, everyone. Let me know if you guys can hear me clearly, and I will keep going. So I am going to be on his YouTube channel tonight at 10:30 p.m. to deep dive Lemonade with Paper Bag and Neil, two members of the Lemonade community. And I thought it would just be fun to do a space and just to warm up my pipes, uh, to talk about a lot of the preparation that I've been doing for this deep dive, and just get a kind of rough draft take on what I've put together. Practice presenting it one time here on X before I do it on Amit's YouTube channel and try to convince who I think is a pretty big influential member of the retail community now, that Lemonade is a really sweet AI company, and that if you're excited about companies like Palantir, you should also be really, really excited about Lemonade. So I am going to go through some of what I've written up, and planning on presenting to Amit, and I also want to allow anyone who wants to ask questions throughout my different presentations that I have prepared, and also give feedback on kind of what I've prepared. If something's not clear, it would be great if you guys ask the question now, so that I could make sure that when I'm explaining it on Amit's YouTube channel, it makes perfect sense, and is well put together. So feel free to request speaking, anyone at any time, if you have any questions. So I'm just going to jump right in. Well, I guess beforehand, I should say, disclaim, I personally own a significant amount of Lemonade. So if you think that makes me biased or whatever, I should just let you know that ahead of time. I'm a big investor in Lemonade. I believe the reason that I am a big investor is because as I researched this company, I just thought the opportunity was insane, and I'm not bullish because I own it. I own it because I became bullish researching it. And then the last disclaimer before we jump in here is that nothing I share on X is personal financial advice for you guys. I'm not a financial advisor. It is just my own research, and you should take it for your entertainment and education. And you guys should do your own due diligence, because you guys are the only ones that have stakes in how you invest your own money. So definitely uh, check everything and watch Lemonade's Investor Day on your own and learn from management directly. That's enough disclaimers. Let's jump in. So the first thing that I want to share with Amit, just to set the stage. And I know that Paper Bag and Neil are going to be there as well, so I also just want to be willing to listen too. But the first time I get a chance to talk, I want to set the stage with some background, to kind of help everyone understand how Lemonade was founded, who's behind Lemonade, what industry they're in, what their current valuation is, and just like give everyone a good starting ground, from which we can build our conversation and our deep dive off of. So I just wrote out kind of 6 points that I'm going to share at the beginning. The first is that I want to make it very clear that I view Lemonade as an AI company. It's an AI company that, yes, does sell insurance, but it is so totally different from an insurance company, in its very foundation, from culture to tech to everything. Like, it is an AI company that sells insurance in the same way that Tesla is not a car company. Tesla is an AI and robotics company that happens to sell cars. But their real innovations are in artificial intelligence and robotics, just like Lemonade's real innovations are in artificial intelligence, automation, and that is going to be what drives the long-term value for Lemonade, is the fact that it is an AI company. The second point of background that I want to get into with Amit is answering the question. Okay, if Lemonade's an AI company, like why did they decide to sell insurance? That's a pretty boring thing to sell, is it not? Aren't there way more cool things that AI tech founders could try to sell than insurance? Well, I have two reasons why insurance was an incredible thing for an AI company to decide to sell first. Um, the first point is that it's fully automatable. If you're thinking about a world now, physical goods are, I think, going to be far more fully automatable long term as you have like Tesla Optimus Bot and Figure and other humanoid robots become more competent. But right now, if you're looking at what industries are fully automatable today without any advances in AI and robotics from where we are, Lemonade is one, or not Lemonade, but I mean Lemonade is doing it, but insurance is that industry that is so easily automatable compared to all other large industries. Like it's much harder to automate, selling oil, right? Like there's physical barrels that you have to ship across the world and stuff. Insurance is literally just selling a financial promise. It's all digital. And because it's all on the digital straight, every single thing that is done within insurance can be done by AI without any future progress in robotics necessary. Um, AI is really good at taking a lot of data points and assessing risk for underwriting. AI is really good at analyzing claims and trying to find fraud patterns and literally do all of the things necessary to pay out a claim. Um, there's literally nothing in insurance that can't be automated. So that's why I think it was a really great idea for Lemonade to as an AI company to say, hey, let's do insurance as our product. And then the second reason I think insurance was a great industry for an AI company to launch into is that it's worth 8% of US GDP. Globally, insurance premiums are 7.5 trillion, trillion with a T, $1 trillion. Insurance is way bigger than many industries in the world. In fact, it is one of the world's largest industries. So even though many people might look at it and just think it's boring, think it's not that interesting, it's massive. Lemonade is a $3 billion company with $1 billion in total insurance premiums in an annual market that is $7.5 trillion of annual premiums. So it's a company in, if you want a blue ocean, it's like one of the biggest blue oceans that you could possibly find. And then the other great thing about it is that it's an industry that hasn't seen much change or innovation in quite literally over 100 years. You have companies in insurance that are literally 100 years plus old, which is crazy. So, like, you have to remember, like, 100-year-old company was founded far, long, long, long before the internet. That's why Geico, famously, Ajit Jain, who runs Geico, famously said, I think a little over a year ago, that Geico has over 600 systems that do not talk to each other. So actually training AI with all these data silos and stuff it's literally impossible for some of these companies. Like these are companies that are doing a lot of their work on paper that say, hey, can we send you mail or fax? That is the type of company that makes up a significant percentage of the $7.5 trillion insurance market. And that is why it is so disruptible and so exciting. And I think it was so brilliant for Shai and Daniel, the two co-founders of Lemonade, to launch this AI company with insurance as their first product. And that moves me to the third point of background that I want to be covering with Amit tonight. And that's the proven founding team. Shai Wininger, I think, is a Steve Jobs-esque founder. And I'm not just saying that as hyperbole. Daniel, his co-founder, would agree and actually said it first. And Daniel has actually, met with Steve Jobs before. And Shai is someone who had a very successful startup before this, Fiverr, which went public. I believe Fiverr is worth over $1 billion. So he's founded a unicorn before this. And I believe it was shortly after Fiverr went public that Shai was wondering, what should my next startup be? What industry should it launch in? And he was getting excited about artificial intelligence, and he was taking a Stanford class just for fun, and learned that insurance was 8% of GDP, and hadn't seen disruption. And he was like, man, maybe insurance is where I should be looking at for my next startup after Fiverr went public. So he and Daniel, by the way, is successful founder as well. Daniel um, sold his company to SanDisk, and was mentored by the CEO of SanDisk, really big company. Um, Daniel and Shai determined that insurance was the most disruptable business in the world, was the most disruptable market in the world. And that is why these two founders decided that Lemonade, as an AI company, was going to take on the insurance industry. So remember what I covered here: fully automatable, worth 8% of GDP, and it hasn't been disrupted in 100 years. So that is why they decided to launch Lemonade, an AI company in insurance. All right. So then the third point of background here that I want to cover is that, on top of just automating insurance, which is going to greatly cut costs, it's going to allow Lemonade to be a cost leader and a margin leader, because you have to remember, big insurance companies today, about 30%, for many of them, about 30% of premiums is spent in operating costs, paying the insurance agent, paying all of the human employees. So if you can automate that, you cut a huge percentage of the cost, which allows you to be a cost leader and a margin leader. I think Lemonade is going to be far more profitable than any of the current insurance companies can even dream of. But the big thing here that I want to cover for this point four is that they are changing the trust dynamics of insurance. And they're doing this, they thought about this from a fundamental level and decided to implement the Give Back program. So um, bear with me for a second here. I know talking about insurance isn't as exciting as the AI aspect, but it's important to understand a fundamental issue in insurance to understand one of Lemonade's big advantages. In insurance, there is a lack of trust between the insured and the insurer. Why? Well, pretty simply because any dollar that an insurance company doesn't pay to you for a claim, they get to keep for profit. So the insurance company inherently wants to pay you as little as possible, wants to pay back as little as possible of the premium that they collect from you. So there is this huge level of distrust. And Lemonade realized this. Daniel and Shai, when they were thinking about insurance, realized this is a big problem. It's one of the only industries where there is really a massive conflict in the relationship between the customer and the company. How do we fix this? How do we fix this? And they came up with a brilliant idea of the Give Back program, where everyone who signs up for insurance on Lemonade, they choose a charity where, if the person, it's cohort, so if you pick a charity, then you become a cohort with everyone else who has insurance from Lemonade and also pick that same charity. If your cohort has loss ratios, which means that the percentage of your premium that Lemonade collects, if that loss that gets paid out in claim drops below 40%, Lemonade stop is like limited. They said, we're not going to take more profit than this. So if a cohort has less than 40% loss ratio for claims payouts, any remaining premium is donated to the charity that cohort picked. So it removes this massive trust issue where every single dollar, we don't pay you in your claim, we got to keep as profit, so we want to try to pay you as little as possible. Lemonade changed that dynamic and said, hey, no, we want to be paying out some percentage of claims, and if you guys are honest with us and there's like no accidents or anything, then we're gonna pay out to a charity your leftover claims. So there's hopefully this should reduce the incentive for insurance fraud on both sides, from the insurance company and from the customer, which greatly flips the trust dynamic on its head. And I think this could be one of the biggest advantages for Lemonade long term, is the fact that people are going to trust them more. Thinking really long term, I'm a futurist, so I like to think hundreds of years into the future. When Lemonade is a fully autonomous organization, meaning that the entire company can run without humans in the loop, and I know that might sound crazy and futuristic. Many parts of Lemonade are getting close to that level of automation already. For example, sales. 97% of policies that Lemonade sells are currently sold without any human in the loop, with AI doing all of the customer interaction, and the underwriting to like determine the price of the policy that's being offered and everything. 97% of those policies get sold automatically by AI already. And we'll get into this a little bit later, but many other parts of the business are already being automated. So getting back to the trust dynamic, 100 years in the future, if Lemonade is a fully autonomous organization run by an AI brain, which we'll get into this as well, but Lemonade is literally training an AI super intelligence to run the company, it puts a limit on how much profit that AI can actually get. Right. So it puts kind of a safety net on that AI where if the average loss ratio is under 40%, it's like the extra premiums are getting donated to charity. And that kind of puts a cap on, if there was a future where Lemonade had a huge percentage of the market, put everyone else out of business, it's like they can't then just raise prices an insane amount and abuse everyone. There's a limit on the profitability. So I think that's really important. I think that's enough on the trust dynamic for now, though. So then the fifth point of background that I want to cover with Amit tonight on the YouTube Lemonade deep dive, um, is about how if Palantir, I think Amit will like this because Amit was obviously a big Palantir investor. If Palantir were to start an insurance company, that company would be Lemonade, ontology and all. Lemonade is literally building the company that Andrew Karpathy would want. So um, I already mentioned this, but Lemonade is a scalable autonomous organization. It's run by AI agents that interact with customers, that interact with data libraries, that interact with complex models, other AI agents, etc., all within this beautifully complex ontology. And if you go to my X profile, you'll see this image of Lemonade's AI brain, and it's hundreds of these different dots that are all connected to each other. And this brain shows like different products connected to different models, connected to different features, connected to different data. The definitional kind of Palantir ontology, which if you've never heard that word before, is pretty much just like a structured AI framework of concepts, relationships, and Lemonade has that ontology. This AI brain has neurons that are improving daily based on billions of data points that are connected across all of the domains that make up Lemonade. All the data is in this this training flywheel where the more customers you have, the more data you're collecting, which trains the AI agents faster, which makes them more capable, which lowers costs, improves customer satisfaction, adds more customers, which gets more data, which trains the AI, which gets prices lower, which adds more customers, which gets more data, which allows them to train the AI. It's this flywheel where the moat grows over time as the more customers Lemonade has, trains the AI, makes Lemonade's AI superintelligence they're training even more capable. At a certain point, you reach this level of escape velocity when you catch up. It's similar to Tesla. The reason why I think Tesla has a very good chance of taking autonomous market share for autonomous taxis in the United States and perhaps globally is because Tesla has millions, literally millions of cars on the road with cameras that are collecting driving data that then Tesla can use. It has all of this proprietary driving data that Tesla can use and no one else can use to train Tesla's own driving AI. That creates a data flywheel, and eventually no one can catch up to Tesla in full self-driving skill. Now, with full self-driving, there is a point, right, where multiple companies can get to far better than human drivers, even if Tesla's the best driver. It's like if no AI cars ever crash, I'm not sure if that data if that data advantage stays as big of a moat as it will be over the next decade, probably. Um, but they will reach an escape velocity in driving skill. Tesla will, in a similar way that Lemonade is going to reach an escape velocity in insurance skill, and will have an insurance superintelligence that has just consumed so many billions more data points, trillions more data points, and has been on this training flywheel for so many years, that others are just not going to be able to catch up. They're not going to have the data. They're not going to have the customers. And I know people oftentimes say, like, well, can't traditional insurance companies, can't they just use Palantir and launch their own AI? And the answer is, like, yes, they can automate some things. Like, they can maybe eventually get to, like, 50% automated customer service emails. Like, they can do some of the stuff like that, but they don't have the ontology that is literally training a fully autonomous organization. They don't have the culture. Like I said, Geico with 600 siloed systems just doesn't have the connectivity. It has too much debt, legacy debt, tech debt, to have any chance of doing this. And literally no one else is trying right now. So yes, after and as Lemonade gets more and more successful, more people will try to copy Lemonade. But if that's 3 years in the future, 4 years in the future, 10 years in the future before they start waking up, it's like their AI is gonna be so far ahead that these other guys are just not gonna have a chance at the point where they finally wake up. And the honest truth is, when I talk to people that are working in the traditional insurance industry today, it's like there's really no rush, to implement AI. Ajit Jain just said during the last Berkshire Hathaway meeting that Geico, for example, has made no big time effort towards AI. They don't want to spend money on it yet, and they are staying in a state of readiness, which means they're doing nothing with AI. So these sleeping giants, these 100-plus-year-old sleeping insurance giants in the $7.5 trillion industry, they are not prepared for the disruption that's coming. And if you read The Innovator's Dilemma, you'll see that this is just something that repeats over and over and over again throughout history. Um, so within Lemonade's ontology, within Lemonade's brain, of data points, base models like ChatGPT from OpenAI can be used by the ontology to complete small tasks. So the overall kind of like Lemonade intelligence will utilize a bunch of different models within it, different agents within it, who specialize at and get really good at specific tasks. Um, and models, LLMs like ChatGPT, can be used to power voice agents and stuff like that. But ChatGPT as a company, or as an LLM, it has no hope of running an insurance company on its own. Whereas Lemonade's ontology can fully automate an insurance company. That's what they're building towards. So this is not just hyperbole, by the way. Lemonade already, this is how Lemonade recently doubled, already. They went from 1 million to now over 2.5 million customers, without needing to increase headcount at all. Like, literally, it's like a Netflix-like company where you can add 1 million subscribers and you don't need to add a single new employee. And that is where it gets really exciting with profitability, and scalability, as we look forward. Shai Wininger, co-founder, president of Lemonade, was recently interviewed by an Israeli newspaper, and he said, now this is a rough translation. Shai commented under one of my tweets, saying that in his interview was translated to English, probably with like Google Translate, so I shouldn't look that much into the specific words. But he said in that interview that Lemonade could add 1 million new customers once again without needing to hire a single new employee. So this is the sort of scalability that is unheard of for an insurance company. Um, and it's really like Lemonade is really straight out of sci-fi. And that's one of the really big reasons, that I love it. So okay, so we've covered 5 of the 6 points of background that I want to make sure that I get across, early on Amit's YouTube channel. So just to recap for anyone who just joined, the first was Lemonade as an AI company that sells insurance. It's not really an insurance company first, it's an AI company first. Second, why would an AI company sell insurance? It's fully automatable, it's worth 8% of GDP, and it's the most disruptible industry in the world with many 100-year-old plus companies. The third point I gave was talking about the proven founding team, some background on Shai, who previously started Fiverr, and Daniel, who sold his company to SanDisk, and then was mentored by the SanDisk CEO. I talked about the change, how Lemonade is changing the trust dynamic in insurance by building trust with the Give Back program. And then number 5 here, I just talked about how if Palantir were to start an insurance company, that company would be Lemonade, ontology and all. So then the sixth and final point of background that I want to cover the first time that the mic is handed over to me tonight is valuation. Right now, I think Lemonade is very cheap. Um, it is trading at less than 3 times this year's enforced premiums, which is the total annual premiums that Lemonade collects off of its current active customers. So less than 3 times sales, you could think about it in a way. Now, Lemonade does use some amount of reinsurance. It's over, I think, 40% of Lemonade's current premiums they reinsure. And they cannot claim premiums that they reinsure as revenue, even though it is revenue that they're taking in. So on a price to sales, it looks more expensive, but I think that looking at a price to IFP, a price to enforced premium basis, is a lot better way to value them, because that enforced premium, they can turn it into revenue whenever they want. They can literally stop reinsuring on any given year and almost double their revenue overnight. Um, the reason they don't do that is because while they're still a fast growing startup, they want to make sure that there's no major 100 or 1 out of 100 year event or something that really hurts their book and causes some massive payouts. So they're just currently insuring themselves against potential disaster until they start printing a ton of cash and their book really starts growing. Then they'll stop reinsurance, and it's why in my models I have Lemonade's revenue growing by closer to 45% a year um, from year 5 to year 10 in my models, even though enforced premium is going to be growing. It's has guided at 30% CAGR on average over the next 10x from 1 billion to 10 billion in IFP. That's directly according to Lemonade's management. So trading at 3 times enforced premium, trading at only 17 times a look-through price-to-earnings ratio. So if you don't know, a look-through price-to-earnings ratio is just saying, this is like, by the way, a great way to value growth companies. I even think looking at like HIMS, looking at it through a look-through price-to-earnings ratio is really smart. Even an Amazon is still smart to look at a look-through price-to-earnings ratio. And that's pretty much, you say, what net profit margin is this company likely to have once it's mature? And then say, okay, what am I paying for earnings at a mature margin? So right now you're only paying 17 times earnings based off of Lemonade's 1.2 billion in IFP that they'll have this year. If you assume that they get to a 15% profit margin, which I think is very, very conservative. I think Lemonade long term is going to be able, because of their automation, is going to be able to get to over 15% profit margins. But if you do 15% profit margins on 1.2 billion of IFP this year, it is trading currently at around 17 times earnings, look through earnings. So for a company that's going to be growing revenue over 40% a year, IFP 30% a year, for probably like the next 7 years, paying 17 times earnings for that is insanely cheap. My mentor, who taught me investing initially through pages, not one on one, was Peter Lynch. And in his book One Up on Wall Street, if you don't know Peter Lynch, one of the most successful hedge fund managers in history, when he was managing for Fidelity, he averaged 29% annualized returns for a decade, which is insane for the billions of dollars that he was managing. It's much easier for me to get high returns than him because I'm managing far less money. So I really look up to him, and he is famous for despite managing a super big fund, he would invest in super small growth companies similar to Lemonade. So I think his rule of thumb for valuing growth companies is really good. And he says that if you're paying a PE equal to the growth rate, that is around fair value if that growth rate is sustainable. So if a company is growing, 40% per year on average, and that's a sustainable growth rate, paying 40 times earnings, Peter Lynch would say is fair value. If it's trading at half a PE to its growth rate, it is extremely undervalued, a really good deal. And that's pretty much the story right now for Lemonade. Albeit this is a look through PE. Lemonade's not these profit margins yet, but I think they'll be able to get far beyond them long term. You're paying 17 times earnings for a company that is going to be having, 40% revenue growth, 30% IFP growth. So you're paying about half a look through PE as growth rate, which Peter Lynch would say that paying half the PE for growth rate is really really cheap. He would say expensive is if you're paying double the PE, just as a general rule of thumb as a growth rate. So if a company's growing 40%, you're paying 80 times earnings for it. Peter Lynch would say that's on the expensive side. Just so you know. So that's how I look at it. So at 3 times IFP, at 17 times look through PE, growing 30% annually top line, Lemonade is very, very cheap in my opinion. Another way that you can value a company is through a discounted free cash flow model. So my discounted free cash flow model is literally based on management's guidance, and then it's a little bit conservative to management's guidance. And when I discount at 15% annually, my 2035 valuation, so my 10-year out price target, if I discount that back 15% annually, a discounted free cash flow value for Lemonade of $190 today. And it's trading at 45 or 40, something like that. So it's about 4, 8, 12, 16, 20, about 5 times undervalued according to my discounted free cash flow model. This isn't crazy. If you look through the Lemonade community, many people have price targets between $90 and even like $250. Lemonade's own CFO, Tim Bixby, ran a discounted free cash flow last year back in 2024. So Lemonade has almost had another year of growth since then, and stellar execution since then. And last year, Tim Bixby, the CFO of Lemonade, said based off of his discounted free cash flow model, Lemonade was worth $90 a share. That's back when it was trading at $15 a share. So we're still 50% undervalued based off of Tim Bixby's DCF model last year. So I think no matter how you look at it, if it's 3x IFP, whether it's 17 times look through PE, or whether it is my current discounted free cash flow valuation at a 15% discount rate of $190, no matter which way you slice it, I think the company is very, very cheap. Especially if you compare it to other AI companies. I think it's super super undervalued. So just remember to put it into context here: $3 billion startup with $1 billion in premiums in a $7.5 trillion blue ocean market that hasn't seen innovation in 100 years. So that means that if Lemonade even took 5%, yes, 5% of the global insurance market and traded at the same valuation multiple that it's trading at today of of 3 times in-force premium, at 5% global market share, Lemonade is worth $1 trillion. At 5% market share, $1 trillion. Insurance is even bigger than automotive, what Tesla's going after. So this is a huge opportunity. It is not insane to say that Lemonade could be the next $1 trillion AI company. So questions here. That's the end of kind of the background that I want to share on Amit, or comments. If you have any comments, is that way too long to share? Is it just going to be like I'm rambling nonstop? I need to give Paper Bag and Neil more time to talk. Let me know what you guys let me know what you guys think. I'm going to invite some of you to speaker, but feel free to raise your hand if you have a comment, question. All right, it doesn't look like anyone. I'm not seeing any hand raises or anything. So I'm going to move on to the next part of my presentation. So, the first time I'm planning on giving that background. I'm guessing Amit's going to have questions. I'm guessing Paper Bag and Neil are going to have many things that they're going to want to add to that. But I am guessing um, that there's going to be an opportunity later down the conversation to kind of walk through some other slides that I've prepared. So one thing that I want to share in support of the argument that Lemonade can become a $1 trillion tech giant is just a little bit of support for their execution. I think that Lemonade management's execution thus far has been second to none. And here's some of the data points that back that up. They hit 1 million paying customers. Lemonade did 1 million paying customers faster than Netflix, faster than Spotify, and yes, even faster than Amazon. That's really impressive. Hitting 1 million customers faster than Amazon, Spotify, and Netflix, which are top tier, some of the best companies in the entire world, just shows you the stellar execution behind Lemonade. This is not a new management team. This is a management team with previous unicorns. You know, they're going big this time. They're trying to create their legacy with Lemonade. So yeah, hitting 1 million paying customers faster than Netflix, faster than Spotify, and faster even than Amazon is really impressive. Lemonade grew or has grown 10 times, 5 to 10 times faster than the most formidable insurers in the United States, including Allstate, State Farm, USAA. Obviously, if Lemonade is going faster, hitting 1 million customers faster than Netflix, Spotify, and Amazon, then growing an order of magnitude more than traditional insurance is kind of par for the course. But it took Lemonade only 4.25 years. So 4 years, a little over 4 years and 1/4 of a year, 4.25 years to hit 1 million. Compare that to Allstate. It took Allstate 22 years. It took State Farm over 20 years. It took Geico almost 30 years, 28 years. It took Geico to hit 1 million customers. USAA, it took them 47 years to hit 1 million customers. So Lemonade doing it 10 times faster in just 4 years. Imagine if they were such a slow growth company, it took them 40. Yeah, no, they would not be beating Amazon to 1 million customers, Netflix to 1 million customers, and Spotify to 1 million customers. If they were as old and slow as the dinosaurs that Lemonade is competing against in insurance. I think the third point showing their execution is that they achieved 150% average compound annual growth rate in their top line in their first 5 years. That was their average growth rate in the first 5 years. That is faster growth acceleration than Meta, Facebook, in Facebook's first 5 years, Amazon once again, than Apple had in Apple's first 5 years. So um, it's not crazy to say that they can become a $1 trillion tech giant. They are currently competing at that level in their early stages and growing faster than these current tech giants. Another important point is that growth has been accelerating for Lemonade now for 7 straight quarters. 7 quarters in a row, in-force premium has grown faster than the quarter before. And management is guiding that growth rate acceleration is going to continue. They're going to hit a little under 30% growth this year. Next year, they will be over 30% growth. So that slow acceleration and annual growth rate is going to continue. If the stock does pump, now I agree with management that as a long-term shareholder of Lemonade, we need to be short-term patient and long-term greedy. But and I think there's a good chance of this, the AI zeitgeist, the AI hype does application companies like Lemonade at some point in the future, and the stock does run, um, Lemonade could do a raise. They don't need to do a raise. They're going to hit profitability. I mean, they're already cash flow positive already. They're going to hit profitability without needing to do a raise. But if the stock were to shoot, like fly past fair value of $190, so more like Lemonade accelerate their growth rate probably back into the 70-80% range. So that's totally possible. But assuming the stock stays boring, the stock stays undervalued, which is totally fine. I'm okay with that as a long-term investor. The growth rate is going to continue accelerating and has already been accelerating for 7 straight quarters. Um, and that growth rate is going to average over 30%. I think as management is guiding on this next 10x from 1 billion to 10 billion in enforced premium. Here, that the management is executing on the level of a $1 trillion tech giant is that they have matched or beat their own guidance for 19 straight quarters after becoming, which is really, really incredible. So yeah, maybe insurance isn't sexy, but it's worth 8% of GDP, and it's an industry that's plenty big enough to build a $1 trillion company within. So yeah, I would I know it's really exciting to chase the private, base model LLM companies right now. The private market is blowing up. Companies like OpenAI and Anthropic, they're trading like over 100 times sales. People can try to chase those companies if they want. But I think the real value we're going to learn is actually, I mean, yes, they're going to have real value. The base model LLM companies are going to have real value for sure. But a lot of the value is going to be captured by companies, the application companies like Palantir, like Lemonade, like Tesla, the companies that are using this AI, these base model LLMs to provide real value in the real world by building these incredible insurance ontologies and insurance superintelligences with the training data. Um, so this is something I want to share. I think it's really important. My mentor Peter Lynch taught and went up on Wall Street that no one is looking at. That's where the real gold is. This is a quote from his book, One Up on Wall Street. He said, quote, "I prefer to invest in low growth industries like plastic knives and forks, but only if I can't find a no growth industry like funerals. Um, that's because for every single product in a hot industry, there are thousands of MIT graduates trying to figure out how to make a cheaper version of it in Taiwan. Whereas in a no growth industry, especially one that's boring or upsets people, there's no problem with competition. There's no MIT graduates launching insurance companies. And that's why the industry. That's the end of the quote, by the way. And that's why the industry, hasn't been disrupted in over 100 years. And that's why Daniel Schreiber and Shai Wininger decided to start this company, because they saw this massive opportunity of a $7.5 trillion undisrupted industry of dinosaur companies. But then Peter Lynch goes on. He goes on. He says, quote, "If it's a choice between owning stock in a fine company with excellent management in a highly competitive and complex industry, or a humdrum company with mediocre management and a simple-minded industry with no competition, I take the latter," unquote. So Peter Lynch is literally saying he would rather buy a decent, okay management in a single-minded industry than an excellent management in a highly competitive industry. And I think with Lemonade, we get this incredible opportunity where we have a highly competent, excellent management in a humdrum industry with no real competition. So I think this is really one of those gems. I mean, I wouldn't be all in on this company if it didn't just beat all the other companies I looked at in every single metric. And I'm very bullish on HIMS. I'm very bullish on Tesla. I think Upstart is a great company. I really like Root. I love Oscar. I think there's Hood. Hood I think is a great company with a lot of opportunity. I like Coinbase. These companies in my models. I like Shift4. And Lemonade beats them all over 10 years and 20 years. And I don't care what happens in the next 5 years. Any of those companies could be eliminated in the next 5 years. But long term, when I look at the total addressable market, the just blue ocean before Lemonade, their execution, how their AI advantage is just going to continue compounding and their moat is only going to grow. And all of these different factors, the current dirt cheap valuation, cheaper than any other of these companies with a lot of opportunity. Um, I just have to put all my money in my best idea. Um, so yeah, I really really like Lemonade. Okay, so that is another one of the write ups that I would like to share. So hey, AI, do you have any comments or questions or thoughts? Or
Hey Jake,
hey,
can you hear me okay?
yeah, I can hear you great.
First of all, thank you for putting out all of this research and narrative. It's just really thoughtful and a value add to the community of people that are interested in the name. Really appreciate it. The time, it's very appreciated. Um, I wanted to
Thank you.
I wanted to just touch on sort of up level this to the view that we all I guess have. Probably everybody on this spaces probably has a similar view that we think the company has a lot of intrinsic value and that the value is going to manifest over some period of time. So if we kind of up level it to what's the best way to express that view in the investment markets, I think it would just be maybe interesting for us to take a minute to just think about the different ways that one might express this view. And I have sort of a take that I wanted to get your thoughts on, which is sometimes with these companies that tend to move in very violent waves, like Tesla's a great corollary. You made a lot of money trading Tesla. I've also made some money trading Tesla. It's similar to, it seems similar to Lemonade in that it's sort of misunderstood for a very long period of time. And then the understanding of the market tends to generate these sort of long basing periods that are very volatile, followed by a paradigm shift and a new reset valuation. So like in Tesla, we saw this in the early 2010s with the release of the Model S, where we had basically 1,000% move, and then we kind of saw it again in the 2019-2020 period where we had that next paradigm. And then in between, you kind of have these very long basing periods. The reason I'm bringing this up is obviously a space is about Lemonade, is that we're actually seeing something similar with Lemonade, right? Where we had this kind of IPO that was a little bit overheated the ZERP era. And then we had this kind of correction, overcorrection that some might think to a lower than intrinsic value level. But if you kind of take the last 5 years together, there's sort of this basing around this sort of $15 to $35, $40 a share range. And the thought process is that the next move to the upside is probably a breakout to a new valuation. I think you probably agree with that, and that's probably part of the reason you've taken such a concentrated position in a relatively short time frame. This is to say, is the best way to express that view through just having a long position, or is there some superior way to express that view maybe in the optionality space? Like for example, if you have a view that Lemonade is set to sort of revalue, you don't know exactly when, but the view is that maybe it's in the next 2 years, then you might look at say like the leaps a year and a half out, like for example the $75 calls that are for January 2027. You can get those for under $10, and then you basically are getting 10x leverage at the $75 mark, and you're able to get a lot better leverage on that view. Is there a reason why you choose just holding the stock long and potentially using a little bit of margin opportunistically instead of taking the view of like you kind of have a high conviction 2 year view on this? Why not express it through some sort of optionality or supplement your long position through some optionality to really capture that convexity, is my question.
Yeah, I think that's a really good question. And I do like the way that you kind of set it up too. Lemonade has gone through this basing period of consolidation over the last 5 years after that initial IPO hype where it ran up to $180 and then subsequently fell back. I think the low now is like around 10 or 15. And now we've had 5 years of base, which funny enough is a similar length of the base that Tesla had before Tesla really broke out.
Yeah, and you
Um,
never tend to move in a straight line after that kind of a basing with a company that's this contested and innovative, right? So it's almost a certainty that when there is a move, it's going to be a really convex move.
Yeah, no, it will be very dramatic at a certain point. I mean, partly just because there's no other option when Lemonade, has double the or double the short interest of the next most shorted insurance company, for example. I believe it's around 30% of the of the float is currently sold short. A lot of my shares on Interactive Brokers are actually linked to short sellers who are betting against me, right? So even a lot of my buying, um, it doesn't even necessarily show up 100% in the stock price yet, because
Yeah.
then Interactive Brokers turns around, lends it to a short seller who then sells my
Yeah,
share back
and we
short.
know we know that the look through on the actual business value is just something that 99% of investors in the space are not realizing. And when they understand this, the probability suggests that you're going to have a really big move in a kind of short time frame. And so I have a fund that is limited regulatorily in terms of what it can invest in, and that's just, I have long positions in Lemonade and some other companies that are high conviction. Personally, though, I tend to think there might be better risk reward in the option space because when you go really far out of the money, the premium is just very cheap relative to what you get. Even if you factor in the decay, even if you say that that it's going to take longer than 2 years and you're going to lose all the premium on the first set of options you buy, when you get that 10 or 20x leverage on the move, you still kind of come out ahead, even if it takes 3 or 4 years for a view to play out. So it's kind of this interesting thing. And then there's also the concept of you could do a combination, and you have such a big position. So I thought that you would have probably be giving a lot of thought to this kind of the trade-offs between these strategies, right? So it's definitely just something interesting, and I play it both ways personally, so I don't really have, I see the merits to both depending on the way you're positioned. And then there's also the element of, if you think it's really undervalued, you could also maybe write the puts, and then you could do sort of a risk reversal where you use the premium you generate writing the puts to kind of accumulate more call options over time and then get yourself more convexity. And if it's going to keep basing, you can kind of get a bigger and bigger synthetic long position for like a lot more than the plus or minus 4 million that you have. If you could be notionally long, for say 10 million instead, and then offset the decay, that could be interesting for you as well.
Yeah, no, I definitely think there's ways to capture more upside. The reason why I have personally been hesitant to use options, because I used a quite a bit of margin back in 2019 on Tesla. I used a ton of margin back then, partly because I just had so much less money. So I felt like the risk wasn't as high to margining out because, if something happened and I were to zero out back then, it's like it was a little enough money
Yep.
where I
When
could,
you're getting
save
started,
it.
you got to go all or nothing. You have no choice, right? Because
Yeah,
otherwise, you,
exactly.
you can't get a significant result because you just didn't have the capital base to start with.
Yeah, exactly. So I was able to turn, 20,000 by using margin into over $1 million on the Tesla run. But you're very right that if I had bought leaps, long dated call options, instead of shares with margin, I would have made far, far, far more than that. And I would have been able to, essentially do even more leverage. The reason why I don't, and this could be one of the few negatives that I inherited from my mentor. But the reason that I don't use options is because Peter Lynch, in his book One Up on Wall Street, which I kind of view as my investing Bible, um,
It's one of the
he
best. It's one of the best ones for sure. I'd say it's top five.
yeah, he Peter Lynch was not a fan of options at all. And I disagree actually with some of the fundamental reasons why he didn't like options, but I did inherit some of his bias. The main reason I prefer to use margin over options if you want to get even more upside potential is because margin doesn't require you to predict timing and options do. And I think time is one of our greatest allies as an investor. And if you buy an option, you turn your greatest ally into your greatest enemy. And that is the dynamic that makes me worried. So that's sad. Lemonade is, they just flipped to adjusted free cash flow positive. They are going to start growing that balance sheet. We're going to see it hit $1 billion probably this quarter, and then it's just going to continue growing from here. We hit EBITDA profitability next year. They're already EBITDA profitable if you subtract growth spent. Then they hit next net profit in 2027. So if you're thinking about when could this company potentially start to get valued based off of its future potential, not fear, which is how I think the market is currently valuing Lemonade, then yeah, over this next 3 years, it makes sense, you know, in the next 16 months, in the next 24 months, is probably going to be when we see the run. Because the market is very forward looking. So the run is going to happen before the profit really explodes. We saw that with Tesla. The stock ran up way before the earnings, but then the earnings, it started coming in, 6 months, 12 months after the stock started running. So the market is looking forward a year. So I think if you're going to use options, this has to be one of the best times, right? But I think I have enough exposure. I have a large enough portfolio now that I feel very comfortable not only not using options, but even like using, I don't think I even need to use as much margin as I did with Tesla initially. I think I can. So my goal is becoming a billionaire. I think that with less risk now, just owning Lemonade shares straight up because I am all in, so have the same upside potential as like a founder. If this, or in my opinion, when this company does 100x, that 100x brings me from 4 or 5 million to million, and then you only need a double. After the 100x, you only need a double to reach
It's
the
fair.
billion.
And then there's the argument that the company is so subscale in terms of where large market cap capitalizations are that when you can get, 100x plus in the long term, you just sleep better at night, just kind of sitting on that position. So that totally makes sense. I do have a follow-up. Um, I know you did some research on other similar companies that are disruptive across different verticals, but have a very similar proposition. And I've been looking into Oscar, which is kind of a related, it seems like they kind of are trying to do what Lemonade is doing, but in the health insurance space, which obviously has unique challenges. Did you look at Oscar and did you develop kind of a view on Oscar? And is there a reason why you went all Lemonade and not at all into like something like Oscar that has similar dynamics in terms of growth plus high intrinsic value plus cash being a lot of the market cap and a lot of the kind of similarities, but in a different space? And like how you view the growth potential as being so different for a company like Lemonade and why you chose that.
Yeah, that's a good question. Yes, I have researched Oscar quite in depth, and I do like Oscar. I think Oscar is quite cheap. I think Mark, the new CEO, um, ex CEO of Aetna, I think he is an incredible CEO. I like that the founder is still there, running the tech side of things. So I'm a big thumbs up on Oscar. I think if you feel like you need a diversified portfolio, then having Oscar along with Lemonade, I think is good. I think especially if we do start to see the spotlight shine on Lemonade, I think that's good for Oscar. In a similar way that the spotlight getting shine on Oscar was good for Lemonade. Oscar coming into the spotlight is what led to this Lemonade deep dive that we're doing on Amit's channel tonight at 10:30 p.m. Eastern time. That said, there are a number of reasons why I decided that Lemonade has a lot more long-term opportunity. And just know, me saying that like Lemonade has more long-term opportunity is not saying anything negative towards Oscar at all. Like almost no company has the same long-term upside opportunity from the current valuation base of Lemonade, in my opinion, based on my models. But let's go over a couple of the reasons that I like Lemonade more than Oscar. So one is simply regulatory risk. So Lemonade has a ton of regulation, right? It's an insurance company. Insurance is a highly regulated industry. However, it is spread over many different regulators. In the United States, for example, insurance is regulated state by state, and it is regulated product by product. So instantly in the United States, bam, you're now dealing with 50 different regulators across the 50 different states. And some insurance policies that they offer, like pet insurance, is actually hardly regulated at all compared to home insurance, compared to car insurance, and especially compared to health insurance. Health insurance is actually the most regulated type of insurance from my research that exists. So Lemonade is not in the most regulated. It's in all these like slightly less regulated, and some of them, some of the products Lemonade sells are not really regulated at all. Also, Lemonade is global. So that diversifies regulatory risk as well. They're selling in Europe, they're in Germany, they're in a handful of different European countries already, and that exposes them to different, once again, even more diversified regulatory bodies. Compare that to Oscar, which is one product in one country. Now that's not okay. It's not quite fair because there technically are different products within health insurance. When I say one product, I mean they only sell health insurance. Obviously, there's a lot of different SKUs that you can have within health insurance. A lot of different ways you can bundle it, sell it to the employer, sell it directly to the customer. So I'm not trying to pretend there's not nuance here, but they sell pretty much all of their policies right now, or a vast majority of them at the very least, all through the ACA, which means they have one regulatory body, the US federal government. And if the US federal government makes a change, that can completely flip Oscar's story upside down. Well, I mean, I think Oscar is still going to be successful, but it could really throw a loop in that story, in that short-term guidance.
Right. You just the
Whereas a
regulatory
single
risk is a little uncomfortable relative to what you have with Lemonade, where it's a little more clear what the path is.
Yeah. So then that leads perfectly into the second reason why I like Lemonade a lot better. And that's that one regulator for Oscar is also just really picky and is literally not because the government is such a big customer for Oscar. The government is going to make sure that Oscar can actually not be that profitable. That's why it's trading at such an insane price to sales ratio, right? Like literally, it is illegal for Oscar to have under a 80% loss ratio.
Yeah.
Whereas Lemonade, it already has a 73%. So instantly, Lemonade has 7% higher profit margin potential than Oscar, that Oscar literally cannot ever have because the regulator says you cannot get your loss, you're not allowed to have a loss ratio under 80%. So long term, Oscar literally needs automation to be able to make any money at all. Like a lot of insurance companies have expense ratios, between 20 and 30%. If Oscar was to have an expense ratio at 20% and then a loss ratio at 80%, there's 0% profit margin left. So that means Oscar literally has to get their expense ratio to at least 15%, even to have the potential to have 5% profit margins on their sales,
Yeah, it's really
which is
limiting.
crazy. Yeah, exactly. So if I'm thinking about like long term, when I start to think about Lemonade, it's like they could, because AI is going to be so much better at underwriting, and Lemonade has so many more data points with telematics and stuff compared to traditional insurers. I think that Lemonade could easily long term, they probably won't get to this loss ratio in the short term because they're going to be focused on underpricing incumbents and taking market share. But long term, once they have the market share that they want, they could easily have loss ratios in the 60% range. Then if you also, have the 15% loss ratio or expense ratio that Oscar needs to get to have a 5% profit margin, you have a 60% loss ratio, 15% expense ratio, and you're at a 75% combined ratio. That's a 25% profit margin for Lemonade. And Oscar can only have a 5% profit margin. They're both just as efficient as far as AI use goes. Like that's insane. Every dollar of revenue that Lemonade can get in that scenario is what, 5, 10, 15, 20, five times more valuable. Every dollar of revenue that Lemonade gets is 5 times more valuable than every dollar that Oscar gets long term. If you're thinking about what can actually fall to the bottom line, does that make sense?
It does.
Yeah. Okay. And then the last point. So the first was regulatory exposure. Oscar having one regulatory body, Lemonade having a ton. Second is potential profit margin because of that fact is much higher for Lemonade. And then the third thing is just the total addressable market. The TAM for Lemonade is insane compared to the TAM for Oscar. Now, that said, Oscar is still like quite small compared to the total size of the health insurance market. So Oscar does have a very large TAM and a lot of growth potential ahead. I'm not saying it can't grow a lot. But when you compare Oscar's TAM only in health insurance, um, only in the United States as well, with Lemonade's TAM in all liability insurance globally. Um, it's just really, kind of it's just a much larger for Lemonade. $7.5 trillion market that Lemonade's going after. I'm not sure the total TAM for Oscar, but it's quite a bit smaller.
Makes total sense.
Yeah. But yeah, I appreciate those questions. You were listening to a lot of that first kind of background I was giving. Do you think it's like maybe too long? Should I try to? Was I explaining stuff? Maybe over explaining stuff a little bit?
I thought it was I thought it was sized appropriately. I think it's good, like giving background as it relates to the genesis of the company. Um, I think you might. I think maybe adding sort of the overheated IPO and the correction and sort of the backfilling of the business into its valuation might add some useful color for people, because people that I talk to about the name often have that they have this sort of negative connotation of before. Like, I always get this sort of, yeah, but didn't they IPO and it was like, they were trading at like 1,000 times sales and it was just crazy and they weren't making any money and the loss ratio, like, so that a lot of people will come in with these preconceived notions, and so part of the background could be kind of getting ahead of that and saying like, yes, there was a moment for all these companies where they were overheated, but lost in the noise was that some of these companies were actually incredible companies, and that was part of the reason why they got such a big valuation. Like fundamentally, like kind of like the way that Palantir trades today, as an example. That could be useful to kind of making the case for now is the time.
Yeah, I like that. I just added that to my notes there, so I'll go over that as well. I appreciate that feedback. I appreciate the questions. I appreciate the questions as well. Brian, I see you in the audience. Do you have any thoughts you want to share about Lemonade, or things you want to mention that you hope I cover tonight on the deep dive with Amit on Amit's YouTube channel? I'd love to hear your thoughts, or AI if you had any others. All right. While Brian is here, let me go over one of the tweet threads that I want to use as inspiration for sharing tonight, if I get the opportunity. Is actually one of Brian McCormick's threads that he dropped recently on 10 charts that show why he is long Lemonade. Um, so let me see. I wish I could. Do you know AI, by the way, how to pin tweets in the space here?
I don't.
Okay, that's fine. Alex has requested speaker. Hey, Alex, how are you doing? Okay, well, feel free to say hi if you get your mic working here. Um, so in Brian McCormick's tweet thread, where he drops 10 charts that show why he's long Lemonade, I just want to cover some of these. So one of them is Lemonade's total customer count. It's been pretty impressive. The total number of customers that Lemonade has grown to in such a short time. So back in 2018, Lemonade had about 100,000 customers in Q1 of 2018. Um, it has been growing every single quarter since then in a very consistent basis, now to well over 2.5 million customers in 2025. 100,000 to 2.5 million in, what is that, 6 7 years? That is that is insane. Talk about the multiple of growth rate. Like going from 100,000 to a million is a 10x, right? So then 100,000 to 2.5 million is a 25x in 6 years, 7 years. That is the sort of customer growth that we've been seeing for Lemonade. Um, and just to make a point to what AI was mentioning about the really big IPO launch and the excitement that the stock ran to, back in 2020 when Lemonade IPO'd, they had well under 1 million customers, and the stock ran up to $180 a share. Now Lemonade has 2.5x, almost 3x from there. If you go 800,000, 8, 16, 24, 2.5 million, 3x in the last 5 years. Whereas, so you have a 3x in customer count, and the stock, yes, it was probably overpriced to 180 5 years ago, but the stock has gone from 180 to 40. So we have the customer count 3xing, and the stock losing 80% of its value, 75% of its value, something like that. So that is where the opportunity is just, it becomes very, very clear when
Jake,
you
I
look at
have
how.
I don't mean to interrupt, but you asked me if I had something valuable for your establishment evaluation. One way to look at it that I've spoken to with my committee before when taking a big position was if you kind of take the business as a sum of its parts and you dial into what you just said, which is the customer count, you can benchmark that customer count to what typical insurance companies pay in terms of CAC to get new customers. And then you can basically find that like a Geico or another property casualty insurer will typically spend anywhere from 750 to $2,000 to get a policyholder, right? And so if you just were to say, okay, the young high demographic policyholders that Lemonade is picking up are worth $1,000 each, and you have 2.5 million of them, you kind of have an intrinsic value of that customer base of 2 to 3 billion. And then you add the cash on hand, the net cash, net assets of around $1 billion to that. And you could almost argue that you're getting the business for free. If you just take that customer acquisition cost and that cash balance out of the equation. And I think it's a really powerful thing because when people look at these stocks, they don't really understand, like what's my downside? What am I really buying? What's like the base case? I think for Lemonade, that's a really interesting point given where it's trading at, that if you just kind of take their net assets and their book, and then you take their customer base and you apply just a general industry CAC to it, like you're kind of getting the business for free, which you think is $1 trillion business. I think it might be $100 billion to $1 trillion business, depending on how they execute. I'm not positive yet, but that could be an interesting way for you to present the downside and the base case.
I really like that. I really like that way to look at it. It's a good way to frame it. I just took a note, so I'll bring that up if the opportunity presents itself. I really like that. Thank you.
For sure.
Hi, Jake. If I can add something to the conversation, it's Alex.
Yeah, for sure. Hey, Alex.
Yeah, I'm sorry, I'm outside. That's why maybe my connection is not good. But you talked before about IFP and about revenue of a company. And me, as a professional accountant, I would like to say that the way revenue is calculated for Lemonade, I think it's not good. If you analyze the company, you have to take IFP as the sales of the company. It just accounting is not perfect here. You cannot make perfect rules for every company, and it can be different. The maybe if you would like to know some background of the story, the idea that they cannot recognize like the revenue in full, and they have to take the proportion on the basis of what is reinsurance but what is not, is coming more like from the commissions. If you take somebody's goods, you sell them, and after that you pay the money for the goods, you cannot recognize the full sale as your revenue. Yeah, you can recognize only the commission as your revenue on the basis that goods that didn't like belong to you, uh, and it was just somebody else merchandise or whatever. It's a little bit like more simplified example what I'm giving, but here with Lemonade, they take reinsurance or they do not. The most important part that the customer belongs to them. You know, That's why it's gonna be their revenue late in the future when we don't use reinsurance. So that's why when I see the people analyze Lemonade and they base their analysis on the GAAP revenue, it doesn't make any sense. People always have to look at the IFP of the company as the total sales. Just my 2 cents. Thank you, everyone.
Thank you, Alex. Yeah, I 100% agree with you. I think that's a really good point. Um, it is very true that right now, on a price to sales basis, Lemonade looks a lot more expensive than it actually is, because Alex is completely right. Enforced premium is almost double what current GAAP revenue is, and enforced premium is the actual total value of all of the premiums that all of the current customers that Lemonade has are paying on an annual basis. And all of that IFP, Lemonade is going to be able to recognize as revenue in the future, once they get to a stage where they feel like there's no need to be reinsuring as much of it. Just so you know, the reason why Lemonade reinsures a lot of it now is just because they want to be focused on growing without risks associated with 1 in 100 year disasters and that sort of thing that they're insuring themselves against, just to make sure that things stay consistent and are highly predictable. But in the future, you know, Lemonade has recently hit free cash flow positivity. They're about to be EBITDA profitable next year. They're going to start stacking that cash balance. And when that cash balance starts to go from $1 billion to 2 billion to 5 billion, there's going to be no need for them to reinsure against these 1 in 100 year events anymore, because they're going to be able to take it on the chin and not care. Once you know they're just printing money with their fully autonomous base that they've been building of a company that's just printing. So at some point, all of this IFP is going to be recognized revenue, and there's really no reason that we should be valuing the company based off of a price to GAAP revenue basis, when all of the IFP is their customers. Hey, Brian.
Hey, yeah, just to add on to that, I think what a lot of people don't realize is first they go straight to like Gap and they see, all right, they're spending a ton on sales and marketing, so they're not really profitable today. But with the 86% annual dollar retention they have, that means that they only have like something like 3.5% of the revenue of a cohort that they bring on in a quarter. Only about 3% of the lifetime revenue of that cohort is in the quarter they spend that sales and marketing. So you're talking like, more than 95% of that cohort's revenue is not happening in that quarter. It's happening in other quarters. And I think when people see like the net income statement, they don't really understand it, and that's why you kind of have to look and see, okay, if we take out sales and marketing, are we approaching profitability? And we saw that in Q4 that they are. Q1 we didn't because LA fires was kind of like a very significant historical event, and I think with Q2 that'll kind of come back into the picture. And that's one thing people should really consider instead of just looking at net income, because a lot of people, they're just not considering the lifetime value of these customers and they're not considering them assets. But that's exactly what they are. You're not spending sales and marketing spend to get only 3.5% of revenue in lifetime revenue. You're getting 100% of revenue, but just 3.5% this quarter.
Yeah, that's a really good point. I think there's a lot of misunderstanding about Lemonade, partly because of the dynamic that you're describing here, where the lifetime value is realized, over the lifetime of the customer, whereas obviously all of the marketing spend is up front. And one of the ways that traditional insurance companies deal with this is through insurance agents, right, where the insurance agent is acquiring the customer, and then the insurance agent. I still see Brian speaking. I'm not talking over him, right?
No, no, I'm on mute right now.
Oh, okay, I don't hear it. It's just my app glitching out. Okay, that's good. Um, so yeah, many people don't understand this dynamic, but one thing that's so silly is that the actual synthetic agent So okay, well, yeah. So what I was describing. So the way that traditional insurance companies deal with the cost of acquiring customers is they let insurance agents acquire the customer, and then the insurance agent collects 15 to 20% of the premium of the customer that they sell the policy for the life of that customer. So it's a massive lifetime cost, even though the traditional insurance companies are okay with it because it takes away that upfront cost that Lemonade currently has to pay out of pocket. But long term, Lemonade is gonna make far more profit off of these customers because they're paying for the customer up front, and then they're not paying out the residual 15 to 20% forever to the insurance agent, which is going to make Lemonade far more efficient on a basis of what percent of that premium is going to drop to the bottom line and end up being net income. But Lemonade had to figure out some way if traditional insurance companies, don't get me wrong, they do spend a lot on advertising and stuff as well, but they had to find a way to deal with that traditional insurance agent system. So let me quickly describe synthetic agents a little bit to help everyone who's listening understand. So synthetic agents right now are added to, well, they're currently paying 80% of the growth spend. So there is a company, a venture capital company called General Catalyst. General Catalyst is actually currently funding 80% of Lemonade's growth spend through the synthetic agent program. Now, these synthetic agents only get paid back. This 80% of spend that General Catalyst is paying only gets paid back as long as the cohorts that General Catalyst and the synthetic agents are buying are retained. And the difference, though, is once they are paid back with 16% interest over the first couple of years of the customer, once repaid with interest, the synthetic agent falls off, and Lemonade retains 100% of that customer's perpetual lifetime value as long as they remain a Lemonade customer. That also means that Lemonade gets all of the upsales. So we'll get into this in a little bit, but Lemonade's average premium per customer just keeps on going up. They acquire customers very cheaply by selling them pet and renters insurance, and then over time, as the customers age, the majority of Lemonade's customers are under 35. As Lemonade's customers age, they love Lemonade. It's the most loved insurance product in existence, the most loved insurance company for those under age 35. As they grow up, they buy cars, they buy homes, and they want to continue using Lemonade. So a customer that Lemonade acquires very cheaply for pet insurance, which traditional insurance companies don't want to pay for because it's such a low premium policy, they eventually upgrade to car and home, and with a very low cost of acquisition, Lemonade eventually gets very valuable customers. And for that reason, I think that even Lemonade's current lifetime value expectations are quite conservative compared to the potential lifetime value of these customers. But sorry, I digress. So once the synthetic agents are paid off, Lemonade keeps all of the upside of that customer. And that's why, in my opinion, adjusted free cash flow, which is positive right now, is actual free cash flow. Because it's adjusted only to back out the synthetic agent's own spending. So it backs out General Catalyst spending, which GAAP accounting requires Lemonade count as their own spending, even though, so Lemonade has to add the synthetic agent spending as debt on their balance sheet, even though the synthetic agents are liable if the customers churn. Lemonade's not liable for that. So the synthetic agent spend is tied to lifetime value of customers, but the synthetic agent spend has to be added to Lemonade's balance sheet as debt, but the lifetime value of the acquired customers, which is what this debt is reliant on, that lifetime value cannot be added to Lemonade's balance sheet. So you have this situation where it looks like Lemonade's book value currently is dropping every quarter because they're adding the debt of the synthetic agent, which Lemonade isn't even liable for. And then they can't add the asset of the customer based off of its lifetime value, which is what the synthetic agent is reliant on to get paid back. It is so freaking silly. Does that make sense to everyone?
Yeah, Jake, and I think, part of the reason there's a lot of opportunity for investors with Lemonade right now is that they don't really understand what's going on. They just look at the balance sheet and they look at the income statement and they're like, well, this isn't for me because it's not profitable yet. But if you dig into the details, that's where you kind of see, there's a lot more going on here than just the bottom line net loss number.
Yeah, precisely, precisely. So, um, Lemonade right now, I think, is as they said in the 2024 Investor Day last year, it is very de-risked. If there was a real worry, back in 2022 or 2021 when the stock was $180 a share, that they might never turn profitable, it's like that worry should be gone now. Since 2022, Lemonade has only raised parts of their guidance. They have only beat guidance given in their 2022 Investor Day. They increased their growth rate expectation by 10% from I think around 20% to 30%. In the 2 years from the 2022 Investor Day to the 2024 Investor Day, they went from burning a ton of capital to being cash flow positive from 2022 to 2024. In the 2022 Investor Day, they were already guiding to hitting profitability around 2027. That guidance has now been unchanged for 3-4 years. So the management has only executed, and because of that, I think the risk of Lemonade is so low now. Like the insolvency risk is so low. Of course, it's never going to be zero. I don't care which company you are. It's never going to be zero. But I just really feel like it's time or close to time for the market to start valuing Lemonade based off of its potential instead of its downside risk. And the fact that it's still has 30% of its float shorted just proves that the market is still valuing it based off of risk, not based off of upside potential, despite the fact that the actual company is de-risked. And like you said, Brian, this is the sort of gem for those that are willing to pull back the onion and look a little bit deeper. Because you're right, if you just look at it superficially, that's why you hear, like I heard someone on Amit's channel, I think during the Oscar deep dive, they were just laughing and joking about how the numbers were trash. And it's just like, I just wish I was on that panel so bad because they're so, in the words of Donald J. Trump, mind the language. They don't know what the fuck they're doing. um, and it's not because they're unintelligent. It's not because they're not super smart, great investors. It's just because if you haven't pulled back the layers of the onion, and you don't realize what's actually going on, it's a little bit hard to see at first glance. And that is why there's opportunity. That is why the 10x hasn't happened. That's why we haven't seen the Tesla like run that we saw in 2020 and 2021 for Lemonade yet, because that ran happened for Tesla right after it hit cash flow positivity and bankruptcy risk came off the table. So
You,
we're literally
you know,
in that same age now for Lemonade.
Jake, I wanted to mention you mentioned risk here, and I think one thing people don't appreciate about Lemonade is just how predictable this business is, and that's why you know not long ago I was 100% in Lemonade, and I'd be comfortable being 100% today, other than a meteor striking Earth, which would have other problems for me. Um, but the business sets its own growth rate, and they pretty much decide how much they want to grow each quarter. Um, they decide how much CAC they want to spend, and because they are in control of their growth, they decide their marketing spend. They can move their marketing spend from pet to renters to home to car to Europe renters expansion. They have all these levers they can pull, which means their kind of CAC to LTV tends to be fairly consistent. Um, and because of that, they get their consistent returns. We know, like, if they say they're going to grow 27% this year, they're going to grow 27. And if they don't, it's because they decided they didn't want to. So there's not going to be like an upside surprise in revenue. Typically, there can be, but and there's not going to be a downside surprise. That, like, we're not going to see a quarter next quarter they're not going to grow 20% when if they said they're going to grow 27, because they get to choose that based on their marketing spend, and they're consistent and good at marketing, and they have a whole methodology there. And that kind of takes out a lot of risk because the amount of variables that change are less. And one of the other characteristics about Lemonade is as they scale and get more customers, their primary cost is really their fixed cost because they have great marginal cost. So as long as they keep getting new customers and growing, 27 to 30% year over year, then their fixed cost becomes smaller, and eventually they get a beta profitability. So every quarter they grow, fixed cost headcount remains the same. Their headcount is only growing a few percent year over year. We just know every quarter they're becoming more profitable, and you'll have some variance quarter to quarter with certain catastrophic events because they're an insurance company that have to cover. But we see overall, in one of the charts I showed on my thread not long ago, their gross loss ratio just continues to go down quarter after quarter. So it's just if their gross loss ratio continues to go down, not only is revenue increasing, but also the profitability of that revenue is increasing even with fixed costs flat. So it's a very unrisky business from that side. Although there is always risk that like I said, a meteor or a giant earthquake we didn't expect hits a major city. So there's always some amount of risk. But as Daniel Schreiber said, it would have to be very apocalyptic in nature, based on the way they're currently structured.
Yeah, exactly. Partly because not only are they across multiple different policy types, but they're also across multiple different continents, right? So their risk is very diversified internationally.
And a lot of it is pet, and pet is not prone to catastrophic events quite like other things are.
Yeah, exactly. And I mean, this is like very dark to think about. But if you did have a new kit or something, the pets are not going to need medical care. Most of them will just be dead. And the clinics you're not going to be able to take them to the clinics either because they're going to be wiped out too. So it's like in a very catastrophic situation, I don't care if you own 5,000 stocks, you're not going to be very happy. So yeah, I think the risk and predictability of Lemonade, the lack of risk and the amount of predictability in Lemonade is very underestimated, um, in my opinion. Are you familiar with the movie Minority Report, Brian?
Oh yeah, yeah, I have that on DVD.
Yeah, so you know how they're predicting who's going to commit crimes before they commit the crime?
Yep, yep.
I think Lemonade is the most minority, in a non-dystopian way, the most Minority Report-esque company because their super intelligence, their ontology, their models that they've been training literally predict the expected loss ratio of a customer before Lemonade decides to target them and advertise to them. So they know who's going to commit the crime before they try to sell them a policy, which is crazy. There's not. I don't think there's another insurance company in the world even attempting that, let alone succeeding at it.
Yeah, and I don't think big companies can even successfully replicate that. And it's not just the technology, it's also, if you think about it, like a few years ago, um, Geico and Allstate were two of the biggest spenders in out-of-home advertising in the entire country. They're spending as much as like Coca-Cola. And what that means is they're just putting up billboards, around the nation that say, "Hey, use us for renter's insurance, use us for car insurance, use us for home insurance, X, Y, and Z." And those don't target customers. And the reason they have to do this is they're already so big that they need to keep the customers coming so that um, their fixed cost is smaller and they just have a ton of customers. They need all the customers they can get. Whereas Lemonade also has the advantage of one of being small, which means they can target their customers more than a big company can. And then two, Lemonade has the technology to be able to target the customers usefully, by being able to connect the lifetime value, the customer acquisition cost between everything on its platform. It's all interconnected, and they're able to figure out what drives the most marketing value. Whereas Geico, we know they have 600 systems. They don't all communicate. they may not be getting the most value out of their ad spend because their ad spend doesn't communicate to every part of the business as cleanly as it does for Lemonade.
Yeah, and because of that as well, it's like they can't even train a risk model based off of actual risk factors because all of the data is siloed in different places. So even digitizing it all and putting it on a single platform, let alone then using that data to train an AI or build an ontology, it's like they just have so much technical debt that it's insane. But then like you mentioned, they're just putting up these billboards, they're just advertising on, on football games. They don't really care who their customer is. And then they don't even try to price them very accurately. They're okay, just pricing you based off of your zip code and your skin color, your age, your marital status. Um, Whereas, like, that is such a terrible way to assess the risk of someone. Whereas you look at a company like Lemonade or even Root. I think Root is doing a great job at this as well, where they're using in-car telematics because every single customer downloaded an app. So they see, like, if you're braking hard, what time you're driving, whether you're texting and driving, all of these far more predictive indicators for your likelihood of getting into an accident. And they can price you so much more accurately based off of your real driving habits compared to a traditional insurance company. And yeah, I think that the big insurance companies are noticing that this is a big advantage, right? Like, I think Root has a loss ratio of like 63%. I don't think it has it's not nearly as exciting because it doesn't have the AI. It's not going to have the efficiency, but it is exciting as far as like an insurance company goes. If you take the AI aside of it, it's probably undervalued as well. Their loss ratios are lower than traditional insurance could even imagine getting loss ratios to because they actually know their driver. But what this means is that they are so much more efficient at grabbing young drivers as well. Because if traditionally, you're 22, male, single, you're going to get a terrible offer for car insurance. Whereas you could be a very cautious driver. And Lemonade is going to price you so much better because they're not pricing you based off of your age and your marital status. They're going to have your phone. They're going to see, oh, look, this guy doesn't speed. This person doesn't text while they drive. They're actually quite low risk. They're responsible. They're going to give you a way better rate than you can possibly get from a traditional insurer. And then on the flip side, there's a 47-year-old Karen out there with a lead foot who texts and drives constantly, who, because she's married in a rich zip code and is older, is priced very cheaply, underpriced compared to her actual risk from a traditional insurance company, and is actually loss making. And guess what? The traditional insurance company has no idea that this customer is loss making. And Lemonade's going to price her accurately because Lemonade can see how she actually drives, how she actually speeds, how she actually texts while she's operating, a ton motor vehicle. So in that sense, Lemonade has this massive advantage. So then you ask, well, why doesn't a traditional insurance company reprice their whole book and like change it? Well, it's because like the amount of innovators to limit here is insane. They would quite literally have to. I think this is literally talked about in Lemonade's Investor Day 2024. If you've seen it, if you haven't, I highly recommend it. They would have to like raise the prices on a huge percentage of their book. They would have to lower prices on a huge percentage of their book. It would just be so disruptive. There's no way management or shareholders of these traditional companies would go for it. It would be a time of utter chaos when you're already collecting 10 billion plus 100 billion in annual premiums. So
I,
it's
I think
yeah, go for it, Brian.
one of the problems Legacy has too is they have a lot of older cohorts, and those cohorts don't necessarily want or are comfortable yet with the idea of being tracked in telematics. And they almost all of them have a telematic option, but people aren't really adopting into it. There's some adoption. But when you look at newer companies like Lemonade and Root, they're very popular with more first time cohorts and skew younger than the traditional insurers. And a lot of the younger insurers, like the first time people under 35 getting insurance for the first time, they've been using their smartphone for a long, long time, and they're very comfortable with using their phone for telematics data and being priced that way. Um, and that gives them an advantage over Progressive or Allstate, who might be able to get a certain percentage to try telematics. But just because of those cohorts themselves, they've already been using those companies for so long, they're just simply, less willing to do that. And that means that their pricing is going to be worse. And that gives an advantage to, new companies who are taking the new cohorts to give them good pricing.
Yeah, for sure. And then when you think about it in the context of AI as well, um, all of this additional data that Lemonade is able to collect on the customers allows them to train their AI models in underwriting so much more accurately with so much more depth on so many more data points than traditional insurance. And this is why I think it's still a common belief that traditional insurance companies have far more data than Lemonade. But Daniel Schreiber, the CEO of Lemonade, has repeatedly said now on multiple occasions that he would not trade Lemonade's data with a single other insurance company. And I think that's powerful. I think that Lemonade has far more data than people realize, and they're using this data to train AI. And like I mentioned earlier in this space, with this training flywheel, where the more customers they have, the more data points they get, the better Lemonade's AI gets at running insurance. That makes Lemonade more efficient, which brings prices down, which adds more customers, which adds more data, which then trains Lemonade's AI faster, makes the company more efficient quicker, gets prices down faster. And you have this flywheel where Lemonade reaches an escape velocity at some point. They might already be there. The market definitely has not recognized anything similar to that, though. They reach this escape velocity where their moat literally gets unapproachable. No, you cannot catch up because Lemonade already has the customers, and their AI is already at a level of skill that allows costs to be low enough that no one else can compete with price. That means no one else can get the customer count they need on a single platform built for training AI, which means they could never train the AI to be as good as Lemonade's. Which means this is I like to invest in companies I think have the sort of moat where they could become literal monopolies. And it's honestly too early to even dream about that, because as I mentioned at the beginning of this, if Lemonade takes 5% of the $7.5 trillion global insurance market, and trades at 3 times IFP, which is where they're currently trading, it's already $1 trillion company with 5% market share. So if they're really building this sort of moat that I think they're building, where no one's going to be able to compete, like 5% could be a big underestimation. And in that sort of a world, you start getting to valuations where people say you're crazy if you tweet about them. But I don't think it's unrealistic. I think that the data advantage, the AI training advantage, the flywheel, the pricing advantage that Lemonade is building here is only going to grow the moat over time and make it harder for people to compete over time. And remember, too, Daniel talked about this in his interview with Neil. I think it's completely ignored by most people, including the Lemonade community. Daniel said that when the crash happened in 2021, it was the best thing that could have happened for Lemonade, because when the hype was big, when Lemonade was getting bid up to the moon, 75% more expensive than it is now with 1/3 the customer base, you better believe the competition was chasing Lemonade's heels. Venture capital investors were throwing money at insurtech companies, insurance startups. There was so much excitement to launch a new insurtech company and eventually go public. Look at Lemonade's valuation. Well, guess what? When that market crash happened, Daniel explained this to Neil, all that competition lost its funding. And because they were all so much smaller than Lemonade, many of them don't exist, stopped competing. So Lemonade got 5 years, has now had another half a decade of time to continue building that moat, continue building that advantage with no new competitors in the space. So now it's like, it doesn't matter when this next blow up happens, which I think is a win, not an if. As long as Lemonade's fundamentals continue moving in the same direction and they really do become EBITDA profitable next year, it's like there's going to be another hype cycle, and all the new insurance companies, insurtech AI companies that try to come up to automate insurance, they're going to be too far behind to compete with Lemonade. in my opinion. And it's funny. People were saying it was impossible for Tesla to succeed as a car company with EVs, but after Tesla blew up, all of a sudden, all this funding went to Rivian and Lucid, and it's so much harder for Rivian and Lucid because now they're competing against Tesla. People didn't believe in Tesla, and Tesla had no one to compete against in EVs. So it's like the same thing. No one believes in Lemonade right now, and they have no AI competitor. And eventually, there's going to be all these new insurtech startups that are going to get all this funding. They're going to be too far behind to compete. But everyone's going to believe in them when they didn't believe in Lemonade at the same stage,
You know,
it's funny.
Jake, what's crazy is no one's really trying to do multi-plan AI policies. Like, I respect Root a lot for what they're working on with car, but there's no one that's really taking a serious effort with AI to do, car, home, renters, pet, everything. There's a lot of companies that just do pet. And there's a few other, smaller companies that are really not getting much VC funding. I think ClearCover is one. In car, that's just it's not doing really well. It's quite small, but Lemonade is basically it. And people sometimes ask, well, what is the moat for Lemonade? Can anybody do it? And the problem is that sure, anybody can start a new AI insurance company, but you start with no data. And it takes you years and years and years and years to get the amount of data that you need um, from ground zero. And the only way VC is going to fund a competitor to Lemonade that's multi-policy is when Lemonade proves that they're able to be massively profitable, in which case, as an investor, you've already invested in a massively profitable business. So you don't really have to worry about the competition coming in and scooping anything away from Lemonade. And Lemonade's also done things Legacy, hasn't done yet. Like Lemonade is in Europe, and they've already got loss ratios that are last year they were already below like 100% gross loss ratio. So they're making improvements there. And other companies, how old is Geico and how old is Allstate, and they don't offer policies in Europe, but then Lemonade is just like 10 years old and does. And I think that's because the way businesses that are founded now, they can be done internationally. They don't have to have branches and physical locations where you sell stuff. It can be all done through an app, and it can be ported to other countries easier. You still need some infrastructure at those locations to handle some things, but it's a lot easier to expand internationally with more like a cloud-based modern system than it was 50, 60, 70 years ago. But yeah, I mean, there's no competition that's really trying to do multi-policy. Root did initially try and do like condo insurance, and over the last, you know, 4 or 5 years, however long it's been since they offered it, they've made essentially no progress. They've been focused, I guess, on car. They didn't get any progress going on condo. Whereas Lemonade has done multi-policy, and they've been succeeding in a lot. They've been massively successful in renters, and they're massively successful in pet. And they're at a point now where, with car, they're at a point now where gross loss ratios are starting to look very interesting, and it's still a new product for them. And if they can succeed in car, it takes them into a massive valuation territory. Right now, if you look at valuation, Trupanion is what, like 2.2 something like that billion market cap. Lemonade is three something billion market cap. Um, and so they're basically being valued kind of like just like a pet company might be. But if you add car to it, Progressive's like 160 billion, something like that market cap. That's massive appreciation if they can figure out car, which I think they will. It might not be immediate, it might not be next quarter, but they've proven that they can do renters and pet already very, very well. So there's huge potential ahead.
Yeah, and they had less data for renters and pet than they have for car now. So it's like I have no doubt they're going to be able to successfully price car with more of an advantage over incumbents compared to pet and renters. As far as data goes, as far as underwriting goes, it's like they're going to be able to succeed at car. I have no doubt. Um, And then, you know, they also, not only do they have a telematics advantage, but they also have a cost advantage where their fixed costs are not scaling with new customers the same way that a traditional insurance company scales, which means that every future dollar of revenue that Lemonade brings in is going to be far more profitable than previous dollars of revenue. Hey, Neil, we're just doing some warm up here before we talk to Amit. You wanna
Yeah,
say hi?
I literally just came to say hi. I was about to put my head down and go to bed, but I saw that you guys were chatting here. So yeah, Jake, we've never actually spoken before. We've traded lots of messages, so it's interesting. It's good to hear your voice.
Yeah, yeah. Nice to meet you as well, Neil. Well, I'll let you get to sleep, but before that, I know one of the things that you talked to Daniel about in your interview with him. For those of you guys who know, Daniel, the CEO of Lemonade, Neil has a great interview with him that I highly recommend everyone in this space listen to after this space is over. But in that, you asked a lot about the background of
Mhm.
Shai and Daniel.
Mm.
Can you just share a little bit? It's good practice here. You'll sleep on it, and your speeches will be even better tomorrow. Share a little bit about the background of Daniel and Shai, the co-founders of Lemonade.
Well, so I know Daniel has like a pretty rich background coming from like a sort of, I want to call it a tech background. Like he worked at SanDisk, and I think that was like one of the manufacturers of like the key components that went into like a lot of music players, like the iPod and several other things like that. And if I'm not mistaken, that company, I need to like refresh my memory and go back and watch that again. But um, I want to say he also had a successful exit from one of his other companies. So I think he had just come out of some of these successes and exits, and he was looking for his next venture, and that's how he was kind of introduced to Shy from Peter Diamandis. I think he's the one that sort of connected the two of them, but I don't really have. Yeah, I'll have a think about how to sort of frame this. I didn't really come prepared to talk about that here, but yeah, Shai also has a pretty rich technical background as well. I know he has like a lot of patents with Apple, and he's a co-founder of Fiverr. So I think it's the two of these guys coming together. It's the perfect marrying of these guys because Daniel is just so polished, and Shai is just the perfect tech guy to partner up with. So yeah, I'll have to think about that. I'll try to come up with something a little bit better for when we talk to Amit.
Yeah, no, that's good. I mean, I think it's just like we have two co-founders here with both have previous billion-dollar exits, which is pretty exciting and rare to have come together. And now they're not first-time founders anymore. Like I think Brian knows a lot more about Upstart than me, but I'm going to just bring up Upstart here and make myself look like a fool a little bit, most likely. But Upstart's co-founders, I think, are incredible. But to my knowledge, Upstart is their first company. And when I was listening to the Upstart Investor Day, it was so funny the CTO saying, if we had known what this was going to be like, we would have started a company in another industry. Now that said, they're killing it with loans, and I think Upstart is going to be massive. I really like the company. But Shai and Daniel, they're not that first time founder proven their stuff. They've both had previous unicorns, billion-dollar startups, and now they were looking like Shai. I know after Fiverr went public, Shai was wondering like, what do I start next? What do I do next? And he was actually taking a Stanford class, and he learned that insurance was worth 8% of U.S. GDP. And then he was looking into it, and he's like, wait, this industry hasn't been disrupted in 100 years. It's like there's literally 100-year-old companies in this massive industry. Maybe there's opportunity here. And then, yeah, like you said, Neil, they were both thinking about insurance, and that's why they got connected. Who I forget the name of the guy who said connected them.
It was Peter Diamandis.
Yeah. So a pretty cool thing here, where they both are very successful founders, and now they're literally starting the company that they think is going to be their legacy. I think one way to think about it is it's similar to like Elon. Elon, his first company, right? Like you're new, even if you're brilliant like Elon, you're new at the beginning. So his first company was like a maps company that he sold. I mean, it was very innovative at the time. I think he's describes it as like one of the very first online maps. I think they sold to a newspaper or something, and then he started PayPal after that. And it was each successive startup it becomes like an order of magnitude more successful than the one before it, because you take the experience from your previous startups and then look to do something even larger. So then Elon goes from PayPal and starts SpaceX and Tesla. So I think in their journeys, Lemonade is Daniel and Shai's SpaceX and Tesla now. Fiverr was Shai's PayPal. So this is a pretty exciting moment with a proven founding team creating an AI company with no AI competition in a market worth $7 trillion. It's a super kind of exciting moment, and I think we've discovered an incredible gem here. That,
I
like I said, is trading at 17 times look through PE.
I've been very
Um,
impressed, Jay, with both founders. One thing that really impressed me, and this is me looking at the company at 2023 backward, was when they raised something like $1 billion back at the height of like the bubble that we now know was kind of like a bubble back then. And other companies, I'm an investor in Upstart now, but like they were buying back shares, like during the bubble when the share price was starting to come down some. But I'm very impressed that Daniel and Shai like had the prescience to realize, okay, things are hot right now. How can we ensure the future of our business? And they raised money then, and that was great flexibility for them in the future. And the other thing is, they seem kind of like a spawner type of business founders. And what I mean by that is they're always looking for new ideas and ways to expand the business. And if you look at each line of the business, it's like, they started out with renters and they've kind of evolved it over time. They started with renters, they went into home. Home was, they grew it, but it wasn't quite what they wanted because home was kind of I guess there's a lot of catastrophic events that were affecting the whole industry. And they started looking at other things and they started growing pet. And in 4 years, they took pet, which didn't exist, wasn't on the initial roadmap. They never started off as a pet insurance company, but they saw it as a good fit for their technology. And they went from nothing to in 4 years having more search interest in Google for pet insurance than Trupanion, which is a leader that's been around for something like 25 years. So that just shows you that they're able to launch new ideas, new products within the company. And you don't just see it in policies, you see it in things in the back end, which, we get glimpses of. Like, for instance, they're working on AI to handle customer service. And instead of like Progressive, who's hiring something like 12 or 13,000 associates to handle their growth and be like service representatives, Lemonade is creating an AI product that you can call up and basically they will, like be a real person, but an AI person that will do whatever you need them to do and have more accuracy than a real person, and things like that. So they're building these products both internally and externally to customers, and that just shows you that they're a spawner type company, and they're very they have a lot of ingenuity, and I think in 5 years from now we'll be seeing all kinds of things that they've developed that we never would have thought of today, which is quite exciting.
Yeah, I mean, I don't want to get too far into the clouds, but I personally think that insurance for humanoid robots is going to be a massive TAM for insurance. If you're thinking out 20 years from now, it's going to be quite an expensive item, likely over $20,000 per unit, similar to car.
That's a
And
great point. I never thought of that. Those are expensive.
yeah, exactly. They're going to be expensive, similar to cars, and people are definitely going to want to insure them, especially if you have it going out and grocery shopping for you. Like, what if it gets run over or falls? Or hopefully you won't need to involve insurance if it just falls down, but if it falls off of something, if it, I don't know. Who knows what negative stuff might happen to bots, but I feel like that's going to be a really big insurance market in the future. And I mean, we don't even need to think about this, right? Because it's Lemonade has 1 billion in premiums today, and the global insurance market is 7.5 trillion. So it's just like the blue ocean is almost inconceivable already. But insurance is only going to keep growing. And even pet, which you just mentioned, Lemonade went from not being in to dominating in 5 years. Pet insurance is growing really fast, actually. I think like 16% a year or something. It's expected to be like $17 billion in the mid 20 or the early 2030s. It's I think only like $6 or $7 billion today. So just off of that, Lemonade has 1 billion in premiums today. It could 5 or 10x, just in insurance, just in pet insurance over the next decade or two. Let alone just the fact that they're multi-product, multi-country. It's insane. Future products to insure are coming as well. So just having a fully autonomous organization um, in insurance, that's a pretty good market to have it in. No matter which way you think about it.
Jake, I have a question for you. So a lot of people who want to invest in Lemonade, they ask, well, I think cars are going to be autonomous soon. I think, Tesla and the autonomy is just going to take over and there's not going to be a need for car insurance. What do you say to people who will ask a question like that?
Yeah, no, I think that's a pretty reasonable question. It makes sense. It's one of the first questions that I asked as well. And I actually did some early write-ups on it. I should actually go find one of those write-ups. It's I tweet so much that I'm gonna have to scroll a ton to find it, about why Lemonade is literally gonna beat Tesla in insurance. Um, Regardless of the fact that Tesla is only insuring their own vehicles. But a lot of the points that I was making is that um, insurance is not something that Tesla, for example, is focused on, or it's not something that Elon, at least, is focused on. And you're only going to be as good as the talent that you have, as the team that you have put together. Now, Elon's super power is attracting good talent, but he has to be utilizing that superpower in order for it to be effective, right? He would have to be actively, trying to recruit insurance people and claim, over and over again, this is going to be really, really big, really important for Tesla. He's not really doing that. He's trying to attract robotics people to build Optimus. He's trying to attack AI people to help make sure that full self-driving works. That's what really matters to Tesla's bottom line. And you see this in a lot of areas. Like Lemonade is not, Tesla is not trying to create a fully autonomous insurance company. Um, for example, one thing that kind of just proves the difference in the type of company that Lemonade's trying to build compared to Tesla in insurance is Tesla does not pay out claims instantly. Why does Tesla not pay out claims instantly like Lemonade using AI when Tesla literally has vehicle telematics and sees that you are in a crash? Like Tesla can very clearly see whether or not you actually had an accident. So why, like, they should be able to see, okay, yeah, the vehicle shows, from our sensor data and our cameras that you actually did get into a wreck here. The AI can verify that and pay your claim instantly. They don't do that. Whereas Lemonade is literally paying 55% of claims instantly without human touch. It's like Tesla Insurance doesn't even have that vision. They're not even trying to do that. They're not even thinking about that. Tesla's AI team is working on autonomous vehicles, not autonomous insurance. So the focus is just very different. And it's just why, like, every time that, like, Amazon, for example, says they're going to get into healthcare, HIMSS stock crashes. But it's like Amazon has failed at competing against HIMSS now like twice, I think. And doing what HIMSS is doing is far more in line with the rest of Amazon's business model than doing insurance aligns with the rest of Tesla's business model. To be, very, very frank, it's a very different business. And then you can just look at other things as well besides the instant autonomous claims payouts that Lemonade has, the give back program, and value alignment that Lemonade has that Tesla doesn't have. Another thing is, have you ever called in to Tesla tried to make, just recently, actually, they just launched it, I think, like a month ago, an AI voice bot that you can call in when you have Tesla insurance. I had Tesla insurance, It is terrible. It's really, really bad. It's like a normal robotic voice that you call into that's not helpful at all. I read one review on Reddit that was literally like, it effing sucks. Whereas you compare that to Lemonade's AI voice when you call into Lemonade, like Lemonade, OpenAI literally released a video about how OpenAI was working with Lemonade to help develop this AI voice bot. It has natural language. It feels like you're talking to a human. But on top of that, because Lemonade's entire insurance stack is built on one AI platform, and if you look at the ontology, which I'll be showing to Amit tonight, the whole brain behind Lemonade's AI, the AI is also useful. It can see all your information. It can make changes for you in your policy. Like it can interact with the whole platform. It has power. It's not a useless assistant that makes you want to say, please let me talk to a human. Please let me talk to a human, like Tesla's. So I just think yes, Tesla's a very epic company. I mean, I became a millionaire with Tesla. I really like Tesla. I have nothing but good vibes towards Tesla. You look at the actual data, the actual facts. As a Tesla fanboy, I was convinced Lemonade was way better. And guess what? When I applied for a premium, or I applied to see what my premium would be with Lemonade, it is way cheaper. I literally saved almost 30% switching from Tesla insurance here in Texas to Lemonade insurance to insure my Teslas. Um, and Lemonade is already thinking about giving discounts for using autonomy and that sort of thing. And is well, I don't know how much I should reveal. But I'm pushing. I'm trying to create a deal. As someone with connections in the Tesla investor community and the Lemonade investor community, I'm currently in the process of trying to get a deal together between Lemonade and Tesla for sharing more API on when Lemonade insurance customers have autonomy enabled, because Shai said that would be very helpful for even reducing prices for Tesla customers even more on Lemonade insurance. So all the data points that I have seen show me that Lemonade is going to absolutely destroy Tesla and insurance. And Tesla is really not even attempting to build a fully autonomous insurance company. Really, the reason, if you listen to Elon when they were first launching Tesla Insurance, the reason Tesla launched insurance in the first place was to help lower the cost of ownership for buying a Tesla, because traditional insurance companies are so terrible that they were just like, for no reason, grossly overcharging Tesla customers because it was viewed as a premium vehicle to get insurance. So it was just making the cost of ownership of buying a Tesla prohibitively expensive, because insurance was so much more expensive on Teslas than other vehicles. So Tesla was forced to create their own insurance company to try and drive cost of insuring a Tesla down, and force the legacy insurance companies to actually be honest and competitive in pricing insurance for Teslas. So that's the reason Elon wanted to start an insurance company in the first place. So it's a completely different vision behind Lemonade than Lemonade, who are literally from day one in 2015 wanted to launch an autonomous insurance company. Go for it, Ironic Ape. How are you doing?
I'm good, dude. Thanks for that's really interesting points. All I was going to say is that when I hear about the arguments for full self drive, and kind of destroying the destroying the auto industry for insurance, it kind of makes me smile, because ultimately there's two elements to the insurance, right? There's the loss ratio and there's the expense ratio, and we know that Lemonade's going to win on the expense ratio. Today, most of the majority of the combined ratio is made up of loss, and if you remove the driver and the risk associated with that, and you shift that liability over to the OEMs, then you're removing that element altogether from the insurance policy. And by doing that, expense ratio takes up a large proportion of the combined ratio. And we already know that Lemonade is going to have the best economics when it comes to expense ratio. So they are going to win. It's as simple as that, because the OEMs might have to go and have relationships with their existing insurance providers like Marsh, Allianz, Zurich, and displacing those when they already have existing relationships for their manufacturing plants, for their employees, for their health services, for travel, for everything else. Full self-drive for an OEM with Marsh or Zurich or Allianz or whoever they're using as their incumbents, it's just going to become a line item for them. So the argument that someone can go to these OEMs and sell their services to them for full self drive, I think it's a really difficult sell personally, and I think you're still going to have this auto insurance policy for consumers. But I think the large majority of the combined ratio will be made up of the expense associated with it, and that's where Lemonade will win.
Yeah, I think that's a really good point. So just to put it in other words, I think it was very clear. But if anyone is new to insurance and doesn't understand the insurance industry, when you sell a policy, some percentage of that policy you're going to pay back out in claims. That's the loss ratio. Another percentage of the policy you eat up just with your employee costs, fixed costs, that sort of thing for running an insurance company. So the point that Ironic Ape is making here is a really, really good one, where if cars crash less often, a lower percentage of the premium is going to actually have to be paid out in losses, which means a bigger percentage of the cost, even if the premium overall goes down. And honestly, because the premium is going down as losses drop, a bigger percentage of that cost is now the expense ratio, the cost of running the insurance company, not the loss ratio that you're paying out for claims. And because Lemonade is going to have the lowest expenses by far with their fully autonomous company, that can add 1 million employees without 1 million customers without adding any employees, Lemonade's advantage compared to incumbents grows in an autonomous future where the expense ratio is a larger percentage of the premium. It is the exact reason why Lemonade today is absolutely dominating in pet and renters insurance, because those are very low premium policies. I think sometimes pet insurance, it can be as low as like $9 a month or something. So the fact that Lemonade has the lowest cost to fulfill a claim and that sort of thing, because 55% of the claims are done automatically without any humans, completely by AI doing the fraud protection and validation and payout and everything, that makes Lemonade's cost of fulfilling claims so much lower than everyone else, that with a very low premium policy like pet, where such a huge percentage of it is the expense cost, already no one can compete with Lemonade. That's why Lemonade dominates pet. That's why Lemonade dominates renters, another low premium policy, because the expense ratio is a higher percentage of it, and no one has a shot at fulfilling claims and having as low of a cost per customer as Lemonade.
One correction there. For pet, it's actually a very significant premium. It's the only second, I think, to car, although home is blended with renters right now, so it's hard to see. But pet is actually like a pretty high premium per year on average. But despite it being a high premium, it's a very high frequency claim product. So one of the reasons why legacy like Geico offers pet, but one of the reasons why companies like Geico that offers pet almost have no mind share and they don't really advertise it at all, is because there's such a high amount of high frequency claims. And every time a physical person has to answer a phone and say, hey, this is Geico, tell me about your claim, that costs them $50 an hour or whatever to do. Whereas Lemonade has a very, very low loss adjustment expense ratio, very low ratio in handling each of these high frequency claims, which makes them a lot more efficient and better at it.
That's a good point, Brian. Thank you for correcting me. I will keep that in mind when I'm explaining things to Amit. But yeah, that's a really good point about the high frequency of claims making that expense ratio and loss ratio higher. A lot of people don't know this. I've run an e-commerce store. It is expensive doing customer support stuff. Like at one point, I had 9 customer support staff working for my e-commerce brand. And I calculated it. It like cost multiple dollars. I think it was like $350 or something per email that my customer support team would send. And because we had a funnel set up, like each customer that emailed in, the funnel to getting a full refund like involved like 3 emails, because we would offer stuff like a free replacement and that sort of thing first, because it's lower cost to us. a full, like going through that full funnel, it would cost like, $10, $15, $20 sometimes, depending on how many emails got sent back and forth. And I realized, wait, like the cost of the jackets that we're sending are only $20. That's our cost of goods. So going back and forth with all these human emails is literally more expensive than just sending them a free thing on their first email. So it's really expensive dealing with customers. And if you can automate all of that, it can greatly reduce the cost of the premium, because the expense ratio is a big percentage of that premium that you're paying. Domian, you requested to be a speaker. How are you doing? Are you there?
Yeah, hi, good evening. No, it's fun to hear you all discussing Lemonade. I look forward to your talk with Amit as well. It's great to have some new voices and familiar faces all mixed up here discussing Lemonade. If there's anything you want me to talk about, go ahead. I'm quite busy with family and work at the moment, so I have a little bit less time to make Lemonade content, but I try to stay as involved as possible, and of course, I'm still a big fan.
Yeah, no, I've appreciated a lot of your posts. How did you hear about Lemonade, and what is your current view on it overall, as far as an opportunity in the market goes? Everyone knows, I think it's 100x to 1000x opportunity. What do you think? Let's get some other opinions in here.
Yeah, I think that's interesting to know. I would like to know that the same from you. How did you come to know Lemonade? For me, I was looking actually at something else after Tesla has had its big run. So I was literally just looking through a list of companies that recently had their IPO. And then if you go through the list, there's a lot of names you can barely read on there. So Lemonade definitely stood out. It piqued my interest, and then I started researching the company, became a big fan, followed the company, bought stock, went all the way up, all the way down, and kept believing, kept buying a little more, and yeah, it's fun when the stock goes back up like now. But of course, I'm prepared to follow it. Well, it's fun when it goes up, but of course, if it goes back down, that's fine with me. I'm a long-term supporter, shareholder, and fan of Lemonade. And for me, the two main reasons why I love Lemonade is basically what Chai is known for. It's mixing technology with sort of, well, design and taste. I think taste is extremely important. It explains a lot of the success Apple has had when you compare it to Microsoft, although Microsoft isn't doing too bad nowadays. But still, when you use an Apple product, even today, I think, even though Johnny Ive has left and and Steve Jobs has been dead for quite a while now, I think there's still more soul in those products than in their competitors' products. And I think the same can be said for Lemonade's app, and to me, that's very valuable. So that's one of the reasons. And then, of course, when I see Shai talking about technical stuff, it really gives me yeah, a great feeling that they're right on top of things. Every new development in AI, they can implement it right away. They have leadership that knows what they're talking about, that knows what they're doing, that knows which direction the world is going to. And they really are a technology company that just happens to sell insurance. The only thing that I wonder sometimes is maybe they could have built a similar company doing something that people actually use more because, well, in the end, you want to use your insurance policy as little as possible, right? Because it's usually because something bad has happened. So that's the only thing I am thinking about. Like maybe they could have built an autonomous company in a different sector as well. Maybe a sector where people and customers would actually use the product more than they do an insurance product. But hey, the reason they chose insurance is because it's such a vast market and unloved market. And I think they are executing really well in tackling those issues. So yeah, I'm still a big fan.
Yeah, I think that's a good point you made there at the end. Like, no one wants to start an insurance company, and that's the very reason that it hasn't been disrupted in 100 years, right? Like, that's why you have 100-year-old insurance companies. Any new MIT graduate that is, bright-eyed and bushy-tailed and wants to start a company, it's like, why would you want to start a company in insurance where, like you said, you have such little interaction with the customer. It's unloved. It's unsexy. It's like you're gonna go start something way more flashy than that. But that's the very reason. And you know, Daniel and Shy both did do other things first. Like, you know, Daniel's first company I think was like doing the USB drive. And then the next one was wireless charging. His company was behind wireless charging and sold to SanDisk. Shy, you know, created the employment marketplace Fiverr, where you can hire people to do anything. Like those are all far more sexy, interesting, techie things. And after those successful startups, they were like, "What's next?" And they both realized, "Wow, you know, a $7.5 trillion market, an undisrupted market for so long, probably, as Daniel has said repeatedly, the most disruptable market in existence today." Fully automatable as well because it's entirely digital. Like AI can literally do every single job in insurance. Like I understand why they went for it. I also think it's why it's still underrated, why we can get it for the price that it's at now. Ironic Ape, you had something else to say?
Yeah, I just love Damien's point. I like, you know, they've in this massively unique situation where they are gathering huge amounts of data, not just data, but risk data, profiling consumers, where they live, what they drive. You know, they are getting all of the data that traditional banks and would love to have. And in terms of a cross sale, if they ever wanted to, you know, go from, like, you know, they would say insurance is the little sister of banking, like they're going to have so much data of so many customers globally that, you know, migration from insurance to providing financial services products at huge margin with less capital requirements, it's, you know, it's an easy move in my opinion in the longer term.
Yeah, no, super long term, they can literally expand. But like we've been saying, you know, they have 1 billion in premiums so far in a market that annually is 7.5 trillion in premiums. So, you know, they can 10x, they can 10x again, and they're still not, you know, the largest insurance company. There's still insurance companies bigger than them after 100x. And then, as we've also mentioned recently throughout this talk, it's like none of the current insurance companies, which many of them are worth well over $100 billion, none of them are international. Like, what are these insurance companies that are 100 years old doing? Why are they not expanding? Why do they not have vision? Like Lemonade's 10 years old, as Brian mentioned, I believe it was him. They're 10 years old and they're already in multiple countries. Like, there's a different vision here and such a big market. And then, like you just said, ironic Abe, it's like having a fully autonomous AI super intelligence running your company. That frees up the humans, you know, to expand into a lot of other things if they want. When the stuff that you've previously built is running autonomously, it's like someone like Shy, who's a Steve Jobs-esque mix of tech and taste and design. It's like he's now free. What's the next thing? What's the next thing? What's the next product? What's the next groundbreaking thing? And Shy and Daniel are still young too. They're both in their 50s, I believe. Ironic Abe, you would probably know better than me. Um, they are young. They have many, many decades ahead where they can truly, I think, grow this into what I think will be a $1 trillion company, at least a multiple hundreds of $1 billion company. And, you know, like I've said repeatedly, the TAM is so big that if Lemonade can take 5% of the global market and trades at the same multiple that they're trading at today of 3 times IFP, 17 times look through earnings, so very, very cheap multiples for a company growing 30% a year. The company is guiding for the next 10x. Very, very cheap, staying at the same multiple. They get 5% of the market share. They're a $1 trillion company. So like, and they're building moats that are much, much larger, I think, than only a 5% type company. And you know, that's why I think it starts getting crazy, right? Like, insane to think about if they took 20% of the market. They're a $4 trillion company. If they could have like 20% profit margins or something much higher than traditional companies today, it's like they could easily, you know, trade. I don't want people to discount me as insane, but you know, I think it could be a up to like a $10 trillion company someday. There's not even a $10 trillion company in the world today. And right now we're talking about a small cap stock in the Russell 2000 that's about to hit profitability. So I'm thinking very long term. You can tell I'm a very, very long term investor, but I think it's just really, really exciting. Okay, did anyone else have a question? I was asked how I learned about Lemonade. I was following Lemonade since the IPO. As a big Tesla investor, I was following Dave Lee, who's a Tesla YouTuber, big Tesla investor, and he actually interviewed the CFO and the CEO of Lemonade on his YouTube channel, and that's where I was introduced to Lemonade. I thought it was really big when Dave Lee said on one of his YouTube videos that I watched that he thought that Lemonade had like a similar upside to Tesla, like way back then. I thought that was pretty crazy, considering that Lemonade was more expensive 5 years ago than it is now, and they've now 3x customer count and stuff like that. And Dave Lee, an investor I looked up to a ton, was one of my mentors that convinced me and helped educate me on investing in Tesla in the first place. That Lemonade was the same sort of opportunity. That made me interested, but at the same time, I learned from other mentors like Peter Lynch and Warren Buffett. And Warren Buffett has a famous quote about IPOs that IPO stands for "it's probably overpriced." And that makes a lot of sense if you think about it from a fundamental level, like what an IPO is about. Its goal is to raise funding for the company. Normally, it has another goal of creating a lot of liquidity for the employees that have been working to build this company, for the investors that bought it in the private market. So I personally don't. I like following IPOs, but I don't like buying them until after all of the share dilution has happened. There's normally a lot of share dilution that unlocks in the first 3 years of a company going public. You have a lot of insider selling. You have, like I said, big insider investors that have unlocks and start selling. And that's why you have this sort of situation where a company goes public, normally with a very small amount of initial float. So there aren't that many shares. There's a ton of hype and promotion around it at the beginning. And you have a thing like, Lemonade going public and running up to $180. And now 5 years later, it's 40. It's a 80%, 75% less. And the company has done nothing but execute and grow since then. So it kind of sucks. But I listened. I took Warren Buffett's words to heart. The IPO stands for "it's probably overpriced." So I was watching Lemonade. I thought it was really exciting. I did have a lot of FOMO. I'm not gonna lie, watching it run up. But I was like, this is one of those things where if I get an opportunity to buy it later, that will be awesome. If I don't, it's okay. You can't win them all. And guess what? Lemonade pulled back hardcore. And back in when the 2024 Investor Day came out, I think I watched it maybe a month after it came out, something like that. I was like, oh my gosh, this company is so much cheaper than it used to be. The majority of the dilution has happened. They just hit cash flow positivity. They've done nothing but beat guidance, since their 2022 Investor Day and raise guidance. Like, this is the time, to get in. And I had just only $100,000 in the stock before the run up from like 15 to 50, and then thankfully it pulled back, and in the low 30 range, high 20s, mid 30s. I all in. I moved my whole portfolio into Lemonade, as many of you who follow me know, and I'm just so grateful that 5 years later we have an 80% discount on a company that's now has 3 times as many customers as it did back then. I just think that opportunity is incredible now. So that's a bit of my background on my understanding of Lemonade.
Great, thanks. So, aren't you a little bit scared that Tesla stock might run up when Optimus gets further developed and robotaxis launch and analysts start putting that into their models and see the potential upside? Don't you feel like you might have exited Tesla a bit too early, or maybe you could spread a bit more between the two? I'm just curious, like, what pushed you over the edge to basically get out of Tesla and put it all in Lemonade?
Yeah, that's a really good question. I still really like Tesla. And trust me, I'm not thinking to myself, I timed the top on Tesla and I'm going to get eliminated. That's not how it is at all. Ever since 2019, I thought that Tesla had the potential to become a $50 trillion company, which it still sounds insane. I understand. But in 2019, it sounded very, very insane because, the Optimus bot hadn't even been announced. I was kind of just going based off of cars, energy storage, and autonomy. And I thought Tesla could get to 50 trillion. So, and I still think that. I think that Optimus is going to be really helpful in that. Now, in my valuation, I still think it will take like 30 years, something like that. But if you think about it, Tesla creating $49 trillion of additional value is insane. Like, if they can do that, they're going to be the first company in history to have ever done that. And I think it's very possible. Meanwhile, Lemonade is a $3 billion company. So if Lemonade created, $297 billion in value, thousands, hundreds of, I'm not sure of hundreds, but thousands of companies have done that before. It's not that crazy. Lemonade doesn't even really need to, come up with new products in order to create $297 billion of additional value. They can do it with just their current products. Whereas, Tesla has to create whole new markets to have any hope of creating that 50 trillion of value. So I think that the road ahead for Tesla to create 50 trillion of value is much harder and requires doing a lot more things that have never been done before in history than Lemonade creating, 297 billion of value. Much less value they have to create in the world. And because of the current valuations that we are starting from, Lemonade creating, that 297 billion, so less than 300 billion of value, Lemonade gets a 100x from that. Whereas Tesla creating 50 trillion of value, much, much harder, way more actual value in the world, they only get a 50x from that. I think that Lemonade has 1,000x potential. There's no way in hell that Tesla has 1,000x potential. We're not going to see. I don't even know what the number above a trillion is, but there's no way it's going to 1,000x from a trillion to whatever that number is. And I think that that's actually quite. I know it sounds insane, but I think it's a very high likelihood for Lemonade. Like, it's not insane. It's maybe only a little bit less likelihood than a coin flip. That Lemonade could 1,000x. That would be a $3 trillion valuation. I know that is also crazy, but like what I just said, just 100xing, just getting are like around the same size as the current biggest insurance companies, which many of them, like Progressive, 160, 170 billion dollars. It is a single product, single country company. It is pretty much only doing car insurance, only in the United States. Lemonade is doing all liability insurance and has aspirations to be global, is already multi-country. So, Lemonade hitting that $300 billion sort of valuation is not crazy to think about at all. So when I just think about it, yes, I still love Tesla. I still think Tesla's going to execute. My initial thesis on Tesla has not changed at all. But after, I already turned $20,000 into $1 million with Tesla. After it gets to this size, there's not as much upside anymore. It's not a small growth company anymore. And then the other thing to think about, just apart from total valuation and total value creation that you have to create in order to get the 50x or 100x multiple between the two companies based on their different bases, another thing to think about is the fact that very small growth companies that are pre-profit, they just trade at different multiples, like at very different look-through PEs. Tesla is not cheap. It's not like, from like a value investor looking at Tesla today, they would say, as a car company, it's insane. Obviously, Tesla's an AI and robotics company, so I don't think it's fair to value it as a car company. But they would say that valuation is insane. You look at Lemonade as an insurance company trading at 3 times IFP and their total enforced premiums. It's really not that crazy compared to a traditional insurance company. And then if you think about like an AI company trading at 17 times look-through earnings, assuming a 15% long-term profit margin, trading at 17 times earnings, growing 30% a year, is insanely cheap. Peter Lynch would say that is a steal for a growth company, highly undervalued for a growth company. Peter Lynch was one of the greatest growth company investors of all time. Whereas you look at Tesla has a lot of future growth priced in already. If you assume, like right now, Tesla's margins, are very bad. They're only like around 5%. I think that Tesla's margins are going to increase drastically. But even if I assume if we do a look through PE on Tesla, say it's at 30% margins, it's still trading at like a 45 or 50 PE on a look through PE. So Lemonade is trading at like a half of the look through PE or more, more like cheaper than Tesla on a look through PE basis, and that's assuming that Tesla's long term profit margins are double the look through PE of Lemonade's long term profit margins. So I'm giving Tesla, a company with 5% profit margins currently, a 30% profit margin for its look through PE, and it is still twice as expensive as Lemonade, while being much bigger and having far lower multiple of total revenue growth potential ahead of Lemonade. So just like it's just much more expensive, has a lot more growth priced in compared to Lemonade. Does that make sense?
Yeah, definitely.
Yeah. So it's just based on both those things. Tesla having to create brand new markets, Lemonade just having a massive blue ocean that they're tiny in, not even needing to create new products now at this point. It's just a much easier road ahead for Lemonade to 100x than it is for Tesla to 50x.
Yeah, well, on their latest investor day, Maya Proser said that they were actually going to launch additional products. I don't think they would say that unless they were already actively working on at least one. So I'm curious, what are your thoughts on what types of insurance Lemonade might launch next? For me, I would guess travel. You mentioned earlier insuring humanoid robots. I think that's a very interesting thought as well, but it's not really something they would be working on already, I think. So yeah, maybe someone else has an idea on what they might be launching in the future.
Yeah, I think those are two great ideas. I'm excited to see humanoid robot insurance at some point. Um, but I probably like the best way to guess would be to look at like, okay, what insurance products now have the biggest total addressable markets that would unlock by launching that product. That could be one way that Lemonade's thinking about it. But yeah, I mean, your guess is as good as mine on what those next products are. But I mean, the bottom line is yes, you're right. They're not going to stop, but they could stop and they could still 100x with the current products. But they are going to continue launching new products, and that is the sort of thing where I don't think it's crazy to think that Lemonade could 1000x. Uh, as I've now mentioned repeatedly. So let's talk about one thing that I want to bring up tonight with Amit on Amit's YouTube channel. Um, it is actually kind of going into Lemonade's ontology, Lemonade's AI brain, and actually talking about the things that Lemonade is automating already. So we've been mentioning a lot that Lemonade's building an autonomous company. Well, what do they actually have to show for it right now? So let's go over just like some of the things that Lemonade has already automated, which is insane. So most of you who follow me already know this, but over 97% of Lemonade's policies are sold by AI already. That cuts out the insurance agent, which in the traditional business takes that 15 to 20% cut forever of traditional insurance policies. It also means that you can scale, you can start selling more and more and more and more policies without having to hire any more agents, any more employees on that sales side of things. So 97% automation there. And that was as of last year, right? So we're probably even higher now. So Maya doesn't take a cut. And guess what? Maya is the sales agent, the sales AI. She also gets smarter every single day because they have that feedback loop that, based off of all of the customer data points, is training her to get even better, to have even higher conversion rates um, on future sales. And the other insane thing is, like, if you just think about the speed of learning, a traditional insurance agent can only have so many conversations with so many potential customers every day. Lemonade's AI Maya, she can have an infinite number of conversations every day with an infinite number, theoretically, right, of customers, as long as Lemonade has enough compute data, as long as they're buying enough Amazon Web Services or Microsoft Cloud or whatever they're using to run Maya. Um, as long as you have enough energy and enough compute, Maya can learn from 1 million customer interactions a day. So the speed of learning between Lemonade's AI and humans, this is where, superintelligence and AI just gets kind of scary. It's going to get so much better at selling policies than a person ever is going to have a chance to, because it's going to have practiced it so many orders of magnitude more than a human could in a lifetime. Next up, claims. Same story. 55% now processed instantly by AI agent Jim, another AI agent that exists within Lemonade's entire ontology, inside Lemonade's entire AI brain. AI is doing the fraud detection, the analysis, the payout in seconds, all of it in seconds. It can browse through hundreds of pages of documents, check pre-existing conditions. It can do all of this work and provide this customer experience that a traditional insurance company cannot even dream of, cannot even imagine. There's no way a human could do it that fast, even if every single claim was instantly tackled by a person the second that it came in the door. So yeah, I recently filed a claim, had a water leak in my house. It is such a hassle. Like, there's a clipboard guy that comes, there doesn't have to be a clipboard guy if AI is doing it all instantly. I had to wait multiple months. The company that did the repairs and my insurance company, they had different estimates. So the insurance guy had to come out a second time. Like, it is just a hassle dealing with traditional insurance companies. So AI Jim, he doesn't sleep, he doesn't get tired, he doesn't screw up. And once again, he's learning from every single claim that comes in. He's getting smarter from. He can spot fraud patterns faster than a human. Like, Lemonade is just going to be able to do inhuman stuff in all of these things. They are not only going to be automating it so they can do it far cheaper than a traditional insurance company, they are going to be better. The AI is going to be better at doing these jobs, not only cheaper than all of the humans that are currently running these insurance companies. And I know that this sort of future can start to seem a bit dystopian. And that's why Elon has talked about things like maybe we need a universal income or something at some point. I personally don't like socialism at all, but maybe the world changes when robots can do all the work. So this is crazy. Lemonade is on the cusp of a revolution that is happening in the world, that is the biggest revolution that we have ever seen in the history of the entire economy, right? Like, this is a tailwind behind Lemonade, that is absolutely insane. So apart from sales, which is 97% automated already, claims 55% automated already, this automation, I should mention, is not, I'll talk about future other things that are being automated, but this automation is not reducing customer satisfaction. In fact, Lemonade's management has talked about how every single time they automate something, the review scores go up. Because guess what? If it changes from, waiting 3 weeks for a claim payout to getting your payout instantly, because AI is doing it all, that is going to make the customer way happier. So because of this, automation is actually making Lemonade one of the most loved insurers in America. And for the cohort of 35 under, it is the most loved insurance brand in America. It has a 4.9 rating on the App Store. It is 4.1 rating on Trustpilot compared to like 1-star ratings for all the other insurance companies. It has won JD Power and Forbes awards. And like I said, it's worth repeating, every AI rollout has increased customer satisfaction. And that is absolutely insane. So on top of this, Lemonade has AI Cooper automating HR within the company. AI Cooper takes feedback from the human employees, aggregates it all, helps Lemonade leadership make the company better to work for. And then underwriting, Lemonade has AI models that help price the premium, determine what the risk is. AI can look at millions of data points. A human underwriter can get so good, but cannot. Like I was mentioning with customer support, they can only underwrite so many policies per day, whereas Lemonade's AI is underwriting every single policy and learns from every single decision that it makes. So is going that traditional insurance companies and traditional human underwriters have no shot at reaching. So what's the result of all of this? Well, we're already seeing it, right? This is not just pie in the sky theories. Like we're seeing this in the numbers now. So while in-force premium since 2021 has grown at a 25% compound annual growth rate, headcount since 2021 is up 2% annually. It's insane. Insurance companies have never done this before. So they 2.3x premiums and only grew the team by 1.09x. So, like, this sort of scalability is crazy and is going to lead to profitability that I just don't think the market appreciates yet. I mean, it doesn't appreciate it. So, management looking forward, based off of all of this automation, is guiding for a 30% IFP compound annual growth rate going forward with very few new hires. Shai recently said on an Israeli interview with an Israeli magazine, Shai said that just like Netflix, Lemonade can add 1 million more customers without needing to hire more employees. Traditional insurance companies couldn't dream of being able to say that. And yeah, good investors know what happens when top line grows without like growth in operating expenses. And you don't even need to be a good investor. You don't even need to be able to guess and model this out yourself. Lemonade's management themselves have said that the next doubling of IFP from 1 billion to 2 billion leads to a 20x in free cash flow. So this is breaking the traditional laws of traditional business scaling. And I don't think people appreciate what that means when you break scaling laws that have been in place for hundreds of years.
Jack, I think Damian's had his hand up for a while here.
Okay, yeah, sure. Sorry, I was kind of reading through a post, so I didn't see that. Go for it, Damian.
Yeah, I just wanted to add a little fun fact about their fraud detection. So they do have automated fraud detection, and in fact, when they suspect this claim might be fraudulent, they send a notification to the customer filing the claim saying, "Hey, we're gonna have a closer look at this claim. We're not gonna pay it out automatically." And just because of that notification, half of those suspicious claims are retracted by the customer. So I guess they're quite good at spotting fraudulent claims and then just notifying the customer, hey, we're gonna have a closer look. That already results in half of those claims being just closed, right? Solved. No more problem because the user decided not to go through with it.
No,
Yeah,
that's a really go for it, Brian.
Yeah, we also don't know much publicly about. I know we got to talk with people at Investor Day, but we don't know publicly a whole lot about the fraud side because they really they've done a lot of progress, but they don't want to tell us about it because if they do, then that's one, they can tip off competitors what they're doing, and number two, then it can mean people can kind of cheat the system. So.
Yeah, that's a really great point. Sorry, I'm grabbing water real quick. Does anyone else have anything they want to mention about the automation and stuff that we've been talking about?
While you're grabbing a drink, I guess Blender, Damian, you want to talk about Blender at all?
Yeah, so Blender is basically Lemonade's platform behind the scenes that employees use both to build all their automations and also to test them and also to interact with customers and build things. So it's basically just the core of all their systems behind the scenes. And when you look at the YouTube presentation of the latest Investor Day, you can actually see a demo given by Adina about this platform that shows how they are using AI now or training the AI to help with customer service, right, and answering emails and adding things to policies, etc. So this platform is really built to easily onboard new technologies, new types of AI models. And in fact, when you look at the recent posts by Shai, he talks about the switch they made to agentic coding. So that's only possible because all the employees are using sort of the same central system. And when they make improvements, all the employees can benefit from it. And what you will see in the presentation as well is that it's also possible for people with a non-technical background to use this platform. It's really user-friendly. And so even people who are not programmers, don't have a technical background, can help in training the AIs and can help automate all the processes that run behind the scenes. It's really incredible. You should definitely watch it. It's on YouTube. It's their Investor Day presentation from late last year.
No, thanks, Tommy. It was incredible seeing live at Investor Day how quickly they were able to, Adina was able to make an update or change live through the Blender system. And if you compare that to what Legacy is doing, imagine Legacy trying to make a specific change. One, they don't have the culture of Lemonade and tech companies. So you can imagine, Legacy has Ironic Cape. You might want to talk to this some. They have a lot of systems and they have a lot of meetings and they have a lot of decisions to make and it's very slow and there's so much tech debt that it's very hard to make changes. Whereas with the Blender system and Lemonade being a tech company, they can make these changes, incredibly quick. And that speed or velocity of being able to update and use new AI models and new AI technology means that it's very hard for legacy businesses to be able to keep up with them.
Yeah, that's a really good point. I appreciate you guys bringing up the Blender system. We should definitely make sure we do that tonight with Amit as well. But yeah, you guys, if you're listening to this and you haven't watched the Investor Day yet, like you're missing out on a ton of alpha. Watch their 2024 Investor Day, and they walk through all this. They show you how their employees can continue training the AI in real time, um, based off of how the responses are coming out, to make sure that the AI is continually learning to be better at interacting with customers. And then on top of that, um, just the data flywheel as well, beyond humans having to give input. The model itself, learning from all of the feedback of all of the policies that it sold before and how loss ratios came in compared to expectations, all of that. Like, I think the Blender example, I think someone talked to Shy after, and Shy said that like this was just like barely the tip of the iceberg. Like they didn't show us anything that's actually under the water. Um, it's an example of one way of the type of culture, of the type of structure behind this company that shows one way that they're building an advantage, one way that they're training their AI. I mean, there are really no competitors in insurance for AI, but it's just one way that they're training their AI better than anyone else to do insurance. Um, and it goes across many other areas of the business.
Yeah,
And
with
I
regards
think,
to the culture, I can add some color. I talked at the Investor Day with Adina, who gave the Blender demonstration, and how the AIs fit into their sort of company structure. And she was really adamant that like the AIs, the agents, the models, they are employees basically. And if you work at Lemonade, you need to get along with these AI models, and these are your partners. You cannot see them as a threat that might take your job. You should see them as a friend, as a helper, as a teammate, maybe as someone who reports to you, or maybe you report to the AI. It can go every which way, but this was really crucial. And when talking to all different types of people at the Investor Day working at Lemonade from the different sort of parts of the company, they were all on board with this crucial idea. Like, we are building an autonomous organization. The AIs are our friends. We are building them. We are helping them. And yeah, found it very, very fascinating. And I guess they get stock compensation to make sure that they are not afraid to automate their own job away and stuff like that. But yeah, it's not just marketing talk. This culture really runs deep. I was able to confirm that by talking to people at Investor Day.
yeah, go for it, Brian. That's a really good point, Domi, and thank you for sharing that.
Speaking of culture, who here was listening to Berkshire Hathaway's Ajit Jain when he was talking about how Geico was going to use AI? Did you happen to listen to that, Jake?
Yeah, I listened to it multiple times because it's just so encouraging as a Lemonade investor to hear him talk about they're just sitting on their they're still asleep, with AI.
I saw my share price for Lemonade just going up as I listened to Jit talk. Um, and I wrote an article on this on my blog. Let me just read from like his quotes really quick because it's really crazy what he said. Um, he said he implied that AI is a fashionable thing. He claimed that Geico is not very good at being the fastest or the first mover. He said their approach is to wait and see until the opportunity crystallizes. He said right now that they dabble in AI, that they have not yet made a conscious big time effort to pursue AI, and should the opportunity pop up, we'll jump in promptly.
Yeah, it's so rich. It's just it's just crazy. You have this. Let me just paint this picture the way that Elon described it. So he was asked when he was being interviewed by Y Combinator why he decided to shift his focus back from Doge to his own companies, and he said he realized that trying to cut government spending was like being on a beach and trying to pick up the trash, and it's like a really nasty beach, a lot of trash everywhere, maybe even some feces. And he's like, but then he looks up and he sees this massive tsunami that's coming, 1,000 feet high, about to hit the beach. And he's like, maybe it would be better to work on that. To worry about that tsunami rather that's about to destroy the entire beach and make it disappear, rather than try to pick up trash on the beach right before it hits. So that's the sort of opportunity. Like, it can't get clearer than this. Like, it can't scream at you any louder that AI is the next industrial revolution. Like, it might potentially be bigger than the industrial revolution, bigger than the internet. Like, artificial intelligence, like literally growing the total amount of intelligence on Earth, and that intelligence being capable of doing something like running an insurance company because you can train it to do all of the jobs in insurance. Like, there's no way that opportunity can become clearer. There's no way that you like, Ajit is looking at the tsunami coming, and he's sitting on the beach and saying, if it looks like the tsunami gets dangerous at some point in the future, it's like maybe we'll try to learn how to start surfing. That's what I hear.
Yeah, my feeling was he was writing like Geico's, rest in peace story right there when he read that off. And
Yeah, that's
Warren Buffett, I love Warren Buffett, but man, he said he would take Ajit Jain over all the AI in the world. And, I respect that he, respects his employees. And, I think that's what he was really getting at, because it's the people that use and leverage AI. But I mean, yeah, as you said, I think this is bigger than the Industrial Revolution, because in the Industrial Revolution, you had a person leverage maybe, I don't know, maybe it improves 1,000 times productivity in making like apparel. That was like textiles was the original industrial revolution, like maybe 1,000, maybe, you know, uh, maybe more than that. But with AI, you can literally leverage a limitless, almost limitless amount of people, like an AI agent with enough compute power, you can be a million people. There's no really limit to it other than, the size of your data centers and the amount of computer chips you have. And each computer chip you have is way, 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 way cheaper at processing something than paying a person for an equivalent hour of work.
yeah. No, I think I mean, one of the things about getting older, like, Buffett is a legend. He is an absolute legend. Definitely the goat in many areas. But as you get older, it's scientifically proven. It's like your brain gets a little harder. It has a harder time accepting new ideas, understanding new technology, changing the way that it's always thought about things in the past. So I understand Buffett's perspective. You know, he's when he was born, you know, the railroads were a dream, let alone the internet. Um, so he has watched a lot happen, and he has seen the value of people over his whole life. He has not seen the value of AI over his whole life. AI didn't exist for most of his life. So he is coming from a perspective where, you know, even the thought of a super intelligence, of an AI being more competent or a computer being more competent than a human, I think it's just really hard to wrap your head around when you're in your 90s. So I think we can't fault him for it. If I am as forward looking as Buffett is when I am 90, I will be very happy. I'll be one of those old rickety, you know, boomers saying, "It's a little weird that you want to date your robot. Like, can't you date a normal girl?" But yeah, I mean, hopefully people are still dating normal girls. Population collapse is a very big potential issue. But you know, just trying to prove a point. Things change. Stuff is constantly evolving, and there's going to be new technologies that come out. Maybe it's quantum computing or something. In my 80s, maybe it will finally come out, and I won't understand it as much as the young guns at that point, which we are now, really, compared to Buffett. So we have an advantage seeing where the future is going in many areas, even better than him now, which is why, to be frank, his returns have, you know, reduced over his lifetime. Still legendary, but I mean, he holds so much cash. There's just no way he could get the sort of returns he used to.
Yeah, while we're on the topic of Warren Buffett, I mean, it's interesting. You know, one of the first companies he invested in was Geico, and it kind of has some similarities to Lemonade. Not just because it's an insurance, but one, he actually invested quite a bit. I think it was like around 50% of his portfolio at that time was in Geico, and even Graham broke his own rule and put in something like 25% into Geico. And at the time, nobody wanted Geico. Like all the insurance industry, they kind of like laughed at Geico and they didn't want it. And Geico was actually innovative back then because Geico was more a direct sales. Back then, you know, most insurance was kind of agents, and they had, you know, you would go to your branch and you talk to your local agent, and then they would set you up with insurance. But what Geico did differently was, you know, they targeted government employees, and because government employees at the time were kind of better, less risky than a non-government employee overall. You know, it was a good selection, and they could sell direct to a bunch of government employees at once rather than have a bunch of agents everywhere that you would have to sign up, and that helped them reduce their costs and be more an efficient provider. And I think what that was why Warren was very excited about Geico, because they did things better than Lemonade. And I think now that we fast forward, you know, some 83 or something years forward now, if Warren was the same age now as he was back when he invested in Geico, I wonder if Lemonade is the business that, you know, he might invest in now, just for the same reasons that he invested in Geico back in the day.
Yeah, in many ways. I know it's dreaming, and it shouldn't be part of your own reason why you invest in Lemonade at all. But I think it would be so cool. Buffett has our Berkshire has recently been buying a company secretly, um, that the SEC has said they don't need to disclose because it literally is a small enough company that it would destroy Berkshire's ability to buy any more of it, because it would probably run up once it got announced. It would be pretty cool. This is just dreaming. Like I said, it had nothing to do with the reason you invest in Lemonade, and it's probably not the case. But if the first investment, you know, that puts me on the map, is one of Buffett's last investments, if it was actually Lemonade. Because I think you're right. I think Lemonade shares a lot of those same innovative characteristics that Geico did back when. You're right. Buffett put a huge percentage of his portfolio in it, and in fact, people don't know this about Buffett, but he's been all in multiple times in his career, and in fact, even today. Of his personal net worth, 100% of it is in Berkshire stock. So he only owns one stock on a personal basis. So Buffett is not afraid to bet big on his highest conviction plays. And that is why he has been able to out-return Wall Street so dramatically over such a long career. And the insane thing, though, is if you compare the early days, I know, Brian, you've made some tweets about this in the past with some charts. If you compare Geico's early days to Lemonade's early days, Lemonade is growing much faster than Geico did. I think five, 6, 7 times faster than Geico, to a million customers. 4 years instead of 30 years, something like that. But then on top of that, it's like we're buying Lemonade now at a similar kind of place where Buffett bought Geico. I think he bought Geico, like, what was it, like 10 years after it was founded or something. We're Lemonade right now is 10 years after it founded, and it is 80% cheaper than it was 5 years ago, 5 years after it founded. So we have this opportunity here, and I think it's worth getting into. Like, people think about insurance as a boring business, and I even opened up this space by saying Lemonade's an AI company that happens to sell insurance. It's not an insurance company because of that fact. But if you actually think about insurance as far as business models go, there are very few business models that are as attractive as insurance. Like, insurance, being in insurance is so much better than being like in shoe sales or something. Like, just as far as business model goes, I would much rather be Lemonade than Nike. Nike, every single time they want to make a sale, they have to reconvince you to walk back into a store where you can find a Nike shoe and to buy from them again. And there is a ton of competition, and there is no guarantee like that a customer is going to buy Nike again. Now, Nike does have a great brand, a much better, more established brand than Lemonade has currently. But Lemonade's business model. So then the other thing about Nike, first, before I move to Lemonade's business model, the other thing about Nike is Nike has all of these upfront fixed costs. If you read the book from the founder of Nike, it's not on my bedside anymore. It talks about how hard it was for Nike to scale, because in order to grow sales, they had to order the shoes from Japan months before they would arrive. So you have all these fixed costs. You're paying for cost of goods before you can even make a sale. So they never had any cash at all, because they would always take all of the profit and make an even bigger order for the next order of shoes. So it's such a hard business model to scale, so scary the entire time. Whereas you look at Lemonade, it is a subscription-based sale. So you sell once. A lot of these products, like home insurance, many states require, so it's a required purchase, and then you buy it and it just keeps charging you every single month. A lot of times you're literally paying the insurance through your mortgage, so you're not even directly touching it. So it is such a sticky business where you sell the customer once, and then guess what, every single month it's like you're selling another pair of shoes, and you don't have to do any more work, you don't have to do any more advertising. They're just gonna keep on paying you. And then the other thing is, you get the money up front. There's no real cost of the good. The customer is paying you for a promise that if they have a problem in the future, you'll pay them back. So they are giving you money every single month, and you are giving them nothing in return except for a promise. And you can just earn money on that float until that customer actually has a problem, which sometimes is multiple years. Some customers literally will not file at all for an entire decade. They're just giving you money and you're never giving them anything back. And then at some point in the future, you expect that some percentage of that premium you collect, you will have to pay out in claims, but you're not going to have to pay back all of it. So it's like you're getting a loan for free that they're giving you, that you have to pay back some of. You don't even have to pay back the whole loan, let alone, paying back interest on top of the loan, which the rest of us have to do if we want people to give us money. Lemonade collects the money like it's a loan, and then only has to pay back part of it while being able to use the float and invest the float. I understand why Buffett loves insurance and largely built his empire based off of the float of Geico. And as an investor, I have dreams. I have hopes that someday in the future, Lemonade's going to be able to create potentially an AI that can out earn the market investing premiums. I think that is something that an AI is going to be able to be trained to do long term. I think it'd be great if it was trained on the lessons of Peter Lynch and that sort of legendary investor. And maybe Lemonade could even replicate some of that growth that Berkshire saw because Buffett was such a prolific investor of Berkshire's float. I think something like that would be really cool. But yeah, I just wanted to kind of get across, even though it's not sexy, even though insurance is not an industry that's growing a lot, it is an incredible industry to be in. RDX, you raise your hand.
Um, uh, Thank you, Jake, for giving me opportunity. Just a quick intro. I came to Lemonade as a roller from the Metro Mile, if you remember. It's been a long journey. Disappointed with the acquisition, but it is what it is. Since then, I'm happy with Lemonade progress. My DC is still under like market share price, but I'm seeing the light on the end of the tunnel. Quick question is that do you believe Lemonade has a capability to provide insurance as a service, like software service kind of infrastructure? Do you have any insight on it?
You mean like selling some of their
Yeah,
automation capabilities to other insurance
yeah.
companies? Yeah, I mean, I think they definitely could if they wanted to. I think the bigger question is whether or not they would ever want to. Because the way that I think about it, and I know that this is actually a part of Oscar's uh, bull case, because Oscar's founder wants to sell, insurance software as a service. Um, I think Lemonade kind of just wants to capture all the value themselves. They're a little bit maybe more greedy in that way, which I mean, as an investor, I kind of like it. They're like, why sell the software to another insurance company so another insurance company can sell a policy and automate the claims and the rest of the underwriting, all of that? Like, why sell the software to another insurance company so that they can make higher margins on their customer when you can just steal their customer from them and have them be your customer? At least that's my thought process behind it. I definitely think though that they do have a technology stack that other insurance companies would love to have if Lemonade was ever willing to sell it. I don't know, Brian, do you agree with that?
Yeah, I mean, I think they're going to try and capture all the profits, and that's why they're not like a pure SaaS company. That's why they do it for themselves. And I think what they would do is if there's an opportunity to scoop up more of the insurance market, instead of saying we're going to sell to other insurance companies, I think they'll be like, you know what, we're doing so amazing. Our valuation in the future, our valuation is pretty good. Let's do an equity raise, and let's use that equity raise to really turbocharge growth as, I guess, judiciously as they could as an insurance company so that they can capture more of the market share. But, they obviously don't want to lease it out to other big players. Like they don't want to give it to, Geico, or they don't want to give it to Progressive, because then all of a sudden that makes them more efficient and it makes it harder for them to compete. So there you go.
Yeah, for sure. Um, if in some sort of crazy scenario where it they calculated that it was the highest ROI, they could definitely do it. I mean, they have the best software in the world in insurance by far. I mean, most of these insurance companies, I think all of the legacy insurance companies, they don't even develop their own software, right? They all buy it off the shelf from third parties. So they don't have the engineers to even dream of creating the sort of software that Lemonade has, a single AI tech platform meant for training, an AI superintelligence. Other insurance companies can't even dream of that. So they would love to buy from, they would love to buy Lemonade software if they could. And Lemonade could definitely sell it. I think I have no doubt, but I just don't think they will. Um, that's my personal take at the current moment. Does anyone have any other questions? We've been going a while. I still have more stuff that I could definitely cover, but at some point here, I do want to take a nap before tonight, before Amit's show.
Just FYI, I did put in the chart we were talking about earlier into the commentary feed for this space. So you can see Geico year, their revenue by year in the early days versus Lemonade. So.
Okay, yeah, that's in the comments under this. Yeah, it's insane how much faster Lemonade has been growing than Geico. So your chart shows that Geico in year 4 had 25,000 total customers, whereas Lemonade in year 4 was already at 443,000 customers. So just a little bit more than 25,000, half a million. And then by year 9, according to your chart, which is last time it was updated, where I think we're only in year 10 now, right, for Lemonade. But in year 9, Geico had doubled from year 4 to year 9, from 25,000 to 51,000 customers. And Lemonade went from 443,000 to over 2 million, 2.16 million customers. So 4, 8, 12, let's see, 4, 8, 12, 16, 20. It's like a 5x from year 4 to year 9, while Geico only doubled from a much smaller base. And then you go out to year 14 for Geico, they were only at 143,000 customers. Already in year 9, Lemonade's or year 10, Lemonade's at over 2.5 million.
And I think from premiums, it's even more dramatic. And these are actually, this is adjusted for inflation. So that's not like the dollars in those days. That's if we took it to what it would be worth today. And year 4 for Geico, they were at 17 million in premiums. Lemonade 72 million. Jump forward to year 9, Geico's at 28 million. Lemonade's at 839 million, almost a billion in premiums. Such a dramatic difference. And you can see Geico actually kind of S-curved a bit from about 29 million to 107 million from year 9 to year 14. So, I wonder if Lemonade also has kind of like a leapfrog where, maybe they they're figuring out car, and that's a big S curve for them, where they also similarly jump up dramatically from year 9 to year 14.
Yeah, no, I opened this space with, Lemonade hit 1 million paying subscribers. Let's move to a modern age of company that we view as the top echelon today. They hit 1 million paying subscribers faster than Netflix, faster than Amazon. This is the sort of company, that is generational, that doesn't come along that often. Faster than Spotify. They hit 1 million paying customers faster than Spotify, Netflix, Amazon. They had a faster compound annual growth rate in their first 5 years than Meta had, than Facebook had. One of the fastest growing companies in history, one of the most valuable companies in history. They had a faster compound annual growth rate than Apple in Apple's first 5 years, than Amazon in Amazon's first 5 years. So this company is generational in a way that people do not price in at all today. Go for it, Brian.
Yeah, before we're done for today, speaking of the generational aspect of the company, there's a book I read that was quite good. It was like The Power Law, and it talks about the history of VC investing. And one of the things you notice about VC investing is back in the day, companies used to go public quite early because venture capital, they wanted to get their exit, they wanted to get their return, and then they wanted to move on to another company. But what we've seen over the last 20 and 30 years is venture capital doesn't want to take companies public early anymore. You used to be able to invest in Amazon back when it was less than $1 billion market cap when it IPO'd. When Netflix IPO'd, you could invest in it for less than $1 billion market cap. But today you have companies like Stripe. Stripe's something like 100 billion, I believe now in market cap. It's not public. ChatGPT is what, like 350 billion in market cap. It's not public yet. Um, so you have all of these, so many companies now, where venture capital just has so much money, and they're like, you know what? the bets that do turn out big, they are worth so much money. We are not going to let them IPO. We want to keep the profits to ourselves. You know, we're not going to give them to retail and to everyone else. So they hold on to them, and they just invest their capital into them. So Lemonade, in my view, could be one of the last. You know, there's still a few companies out there, but Lemonade could be one of the last companies in kind of like still an IPO stage where they're like, you know, 10 years or less old, and you can still get it, you know, for a couple $1 billion valuation before they're $100 billion company, before they're massive. Um, if you don't invest in these companies today, you know, 5 years from now, 10 years from now, you may not be able to invest in any of these kind of Amazon, Netflix, or, you know, future Lemonade opportunities. They might not be out there. You know, I feel like this is a generational opportunity. And if you miss it, you might be just buying value down the road a few years from now of companies that are all $50 billion or more when they IPO.
Yeah, I'm so thankful. Like I am genuinely grateful to Daniel and Shy for going public so early as a 5-year-old company and saying, you know, we're building a generational AI autonomous company here. Let's make sure the general population can actually buy into this early, like you used to be able to buy into Amazon early. Because Brian is very right. You know, venture capital has so much capital in it now. There's so much money sloshing around in private companies that you don't have to go public anymore. And a lot of companies like Stripe are deciding not to. Um, OpenAI, you know, so many people would love to be able to invest. Even XAI, Elon's companies, SpaceX, like these companies that are so cool are just not going public. So the fact that, you know, even understanding how much, you know, added stress that can come with being public, added regulatory scrutiny that comes with being public, Daniel and Shai decided to let us be able to invest in them while there was still private market like upside. And I just think that that is really, really cool of Daniel and Shai. And it shows the type of co-founders that they are. That they, you know, they want to make a truly loved insurance brand beyond being a fully autonomous organization. And I think one way that you actually build a very loved brand is that you go public and you allow your customers to own you. Because, you know, as a Lemonade customer myself, now I feel like, you know, I'm my own customer. I'm buying from my own company, and that creates a level of aligned incentives and of positive sentiment that you just cannot have toward a company that you cannot own. I don't know, maybe I'm too capitalist, but that's how I feel. I love being stuff. I love buying my first Tesla from Tesla when I was a massive shareholder of Tesla. Like it just feels so good. Because you know, you can calculate out, like I can calculate out the number of customers based off of my percentage ownership in Lemonade that I currently have. And it's epic. It's like I have like 2,000 insurance customers right now with my ownership, or 2.5 thousand insurance customers with my percentage ownership. Like it is so cool that retail gets to be a part owner in a business that has 100x and more potential. You know, as we've mentioned over and over again, currently a little over $1 billion in total premiums in a total addressable market that is $7.5 trillion in annual premiums, like such a blue ocean ahead. So I think that is a good place to end it. If you guys, if this is whetting your appetite and you want to learn more about Lemonade, I am going to be doing a deep dive. Honestly, we should get Brian on Amit's channel going forward too. It was great having you up on stage. We're going to be doing a deep dive on Amit Investing's channel. He has a big X following. I think he has like 200,000 followers here on X. He has a very popular live stream as well. I think he often has like, you know, 5 to 10,000 people that are watching him live every single market open and close. So he has a big influence in the retail community, and we're going to be deep diving Lemonade on his YouTube channel tonight at 10:30 p.m. Eastern time. And I'm very excited about that. I hope I hope I can convince with Paperbag Invest and Neil's help. Uh, Amit to invest in Lemonade. I think that would be great as far as growing the retail community. And as someone who really believes in Lemonade, I think that if more people invest in Lemonade, that is really, really positive for all of Financial X and all of Financial YouTube. I think that's going to make a lot of very well-deserving retail investors a lot of money. As I opened this with, um, yeah, I've just never been more excited to be an investor right now in this through this AI revolution. And I do not think there is a single AI company um, in the world with as low of a valuation, as much of an upside potential as Lemonade. The fact that they're public is incredible. I mean, I think it wouldn't. There's no way the valuation would be this low if they were a private company. Um, so we have we have a crazy opportunity here that I'm really hyped about. So yeah, hopefully you guys will join us tonight on Amit's channel to continue learning more. Make sure you follow myself, follow Brian. He tweets, has a Substack that's great. Follow Ironic Ape, visit ironic-ape.com. He has a great website all about Lemonade. Like, guys, this is the grassroots sorts of community that was behind Tesla long before Tesla 20X. It's the same sort of quality of people here that are building the grassroots of this Lemonade community. It has those early Tesla community vibes. And Damian shared a lot of value today as well. Make sure you follow him on X too. And yeah, we'll keep this conversation going. This is going to be an exciting decade. I think a lot of this community is going to be getting pretty rich. So you want to make friends with the Lemonade community. Trust me, they're going to be good friends to have in the future. And with that, you have any closing remarks you want to make, Brian?
Nope. I guess Jake, you want to say again what time the call at the mid is? I guess U.S. Eastern time. And appreciate the space today. Appreciate hearing everything you had to say. And you know, Lemonade's a great community. I joined it when it was like we had like 300 people on X in the community, and now it's up to almost, I think, somewhere around 3,000 or getting there. So and everyone who joins, I see them, you know, 6 months later, still talking about Lemonade. They're not just coming and leaving. People are coming and staying. So, so very excited for the future of the Lemonade community.
Yeah, for sure. 10:30 p.m. Eastern on Amit Investing's channel. Thank you guys so much for listening to this space. It is being recorded, so feel free if you joined late and want to listen back through earlier parts of it as well. The recording will be available. And then I will also be uploading it to my YouTube channel as well. So thank you guys all for joining today, and we will discuss Lemonade again soon on X and on YouTube. So bye, everyone.
Cheers.